America is drowning in debt, $39 trillion of it. If you spent $1 million every single day since the birth of Christ, you still wouldn't reach $1 trillion. That's not even 2% of what America owes. It works out roughly to $114,000 for every single American. You've been told it's backed by the full faith and credit of the government. You've been told to trust the process. You've been lied to. It's held together by a system you've never seen, never voted for, and probably never even thought about. It's a global system that forces the entire world to keep using the dollar just to survive. Now it's starting to crack. Countries controlling nearly half of the world's daily oil supply are tearing that system apart. When it breaks, it won't happen to them, it happens to you. Chapter 1. The $39 trillion illusion. The US dollar appears in nearly 90% of all foreign exchange transactions on the earth. 9 out of 10 times a currency changes hands on this planet, one of those currencies is the dollar. When you figure that the earth currently has 180 national currencies, it's clear that the dollar is the operating system that the rest run on. What built this behemoth? Trade data and decades of financial flows point to one central mechanism, the global oil market, which also is ironically denominated in dollars. The global oil market is worth approximately $2.5 trillion per year. In physical terms, that is larger than the market value of the globe's gold, iron, copper, aluminum, nickel, zinc, lead, tin, cobalt, and lithium markets combined. Oil is the single largest traded good in human history, and for 50 years, the vast majority of it has been purchased in American dollars. A Japanese company buying Saudi oil has to convert yen to dollars first. French refineries importing Kuwaiti crude must buy dollars first. Indian power plants importing Iraqi oil have to buy dollars first. It all creates an insatiable demand for US currency. That demand is what absorbs American inflation. It's also what lets the Federal Reserve print money without immediately destroying the purchasing power of every American paycheck. The only reason your groceries aren't more expensive than they already are is because the central banks of Tokyo, Frankfurt, New Delhi, and Seoul are soaking up trillions of American dollars each year just to keep their lights on. And now it is quietly coming apart. Unlike most of the rest of the world, the United States exports more oil than it imports, mostly from either Mexico or Canada. It's a convenient closed North American circuit. What you may not know is that the United States is currently the single largest oil producer on the earth, producing more than it consumes. So while the US doesn't need to buy oil in dollars, it needs the rest of the world to buy oil in dollars. In fact, it depends on it. It's a completely different problem, and one the United States is currently losing. Chapter 2. The 1974 Secret Handshake. In 1944, the United States gathered 44 countries in Bretton Woods, New Hampshire, and they made them an offer. America had all these factories, most of the gold, and a global military posture that could politely discourage disagreement. The deal was simple. Everyone would peg their currency to the dollar. The dollar would be pegged to gold at $35 an ounce. In other words, a dollar represented more than just a piece of paper. It could be a claim on something real gold. And for about 20 years, it worked beautifully. Then the cracks started to show. America made some expensive investments: Vietnam, the Great Society, the space race, a defense budget that would make a Las Vegas whale blush. By the late 1960s, the US was running deficits and printing dollars faster than it had gold to back them. That's when the Europeans, the French in particular, started doing the math. They started looking at how many dollars were actually circulating, and then they looked at America's gold reserves, and they decided those numbers were not adding up. So they started cashing out. Literally. They loaded dollars into hundreds of planes and ships, and they came back with gold. Over 3 years, France repatriated over 3,000 tons of gold to its vaults. Other countries followed. America's gold reserves, once 80% of the world's supply, started draining fast. By 1971, the jig was up. So Richard Nixon went on television and closed the gold window. He announced that effective immediately, US dollars were no longer convertible to gold. He canceled Bretton Woods with no warning and no vote. The Americans called it the Nixon shock. The French called it several things that don't translate politely. Suddenly, the global financial system, previously tied to gold, was now built on, well, a vague sense of trust that America would behave responsibly. Given the preceding decade, it was quite a lot to ask. Over the next few years, things got weird. Currencies floated against each other with no anchor, which led to a massive spike in inflation. The system was held together by good vibes and crossed fingers. Then, in October 1973, the Arab members of OPEC, led by Saudi Arabia, declared an oil embargo against the United States. Prices quadrupled, gas stations ran dry, Americans lined up around city blocks hoping to fill their tanks. The economy, already limping, took a chair to the knees, which is when Henry Kissinger stepped in. Kissinger, depending on your perspective, was either a master strategist or a war criminal with excellent table manners. What he undeniably was effective, something that was in short supply in 1974. The dollar had just lost its gold backing. The economy was wobbling. The US needed a new reason for the world to want its currency, and fast. Kissinger's solution was almost absurd in its simplicity. If you can't back the dollar with gold, back it with oil, something every single country needs every single day. With this idea floating around in his head, he went to Saudi Arabia under the pretense of helping modernize infrastructure. But behind closed doors, the real deal took shape. Saudi Arabia would sell its oil exclusively in US dollars, which meant that every country on the earth that needed oil would first need dollars to buy it with. And just like that, a country that had quietly walked away from gold had created a new rule. If you want energy, you need dollars. In exchange, the US guaranteed Saudi Arabia's security. The Saudis essentially got the most powerful bodyguard in history. America got its monetary mojo back. Both parties went home happy. Within a year, every major oil producer followed suit. No grand vote, no global summit. Saudi Arabia moved, and it made sense, and everyone else fell in line. And the wildest part? Well, some parts of this arrangement stayed classified for over 40 years. The deal that quietly determined the cost of energy, housing, and groceries for half a century wasn't publicly confirmed until 2016, which tells you something. But by then, the system had already been working almost perfectly without interruption for half of a century. Until now. Chapter 3. Enter the Dragon. What Kissinger built did something remarkable. It took America's greatest vulnerability, a currency that was no longer backed by anything physical, and it turned it into its greatest strategic weapon. Once oil was priced in dollars, countries no longer used up their dollar reserves. They held on to them. And when they held on to them, they invested them mostly into U.S. Treasury bonds, which meant that every time a foreign government bought American debt, they were effectively financing Washington's federal government. The U.S. built highways, funded wars, expanded its military, and won the Cold War, all while the rest of the world helped foot the bill. It was like installing a toll booth on the global economy and then making every country pass through it just to turn on their lights. For 50 years, the toll booth held. Then China decided to build a road around it. China currently imports nearly 2 million barrels of oil per day from Saudi Arabia alone. That's enough to fill approximately 127 Olympic-sized swimming pools with crude oil every 24 hours. China is now Saudi Arabia's single largest customer. For years, it's paid for all of that oil in dollars. For each barrel purchased, an invisible fee flowed back into the U.S. system, all because of that deal in the 70s. But it was a different development, quieter and more technical, that revealed China's true game plan. In 2021, a project launched out of Basel, Switzerland's Bank for International Settlements. It was called mBridge, the Multiple Central Bank Digital Currency, or CBDC, bridge. That name is forgettable. The idea is not. mBridge is a system that lets countries move money directly between each other using digital currencies issued by their own central banks. It avoids intermediaries, detours, and most critically, any U.S. oversight. To understand why that matters, you have to understand how things work today. Right now, if Thailand wants to send money to China, it must bounce it through a chain of banks, most of them Western, and then ultimately settle the transaction in dollars using SWIFT. SWIFT is the messaging system that banks use to talk to each other. It processes about $5 trillion a day, and because it operates under Western oversight, the U.S. has enormous influence over it, which means it can be weaponized, and it has been. When Russia invaded Ukraine in February 2022, the G7 kicked Russian banks out of SWIFT and froze approximately $300 billion in Russian Western reserves. If you're another country watching that happen, like China, India, or Saudi Arabia, you start to ask uncomfortable questions. What happens if we're next? China didn't write a strongly worded letter in response, it simply just built its own exit. And that's the gist of mBridge. a payment system that routes around SWIFT entirely. It went live in 2024. By late 2025, Inbridge had processed over 4,000 transactions worth $55 billion, a massive increase from its early tests. But it is still tiny compared to SWIFT. Inbridge wasn't designed to force its users to ask the West's permission to make transactions. It was designed to avoid that, which makes it something entirely new. It's not a replacement for the toll booth, but it is certainly a way around it. America's financial nuclear weapon, its ability to cut off any country from the global economy, doesn't look so unavoidable anymore. And this is where things get scary. Chapter 4 – The Slow Bleed. In June 2024, news exploded across the internet claiming that Saudi Arabia had allowed its petrodollar agreement to expire. The deal was dead. It was time for the dollar to pack its bags. The Saudis were ready to receive payments from a grab bag of currencies, including the euro, the rupee, and even the Chinese yuan. It's a bit of a stretch to say that there was ever a binding legal contract at all. The 1974 bilateral economic agreement between the US and Saudi Arabia had technically expired in 2001, and it was never the legal foundation of anything. The petrodollar system was never a treaty but a structural agreement, a self-reinforcing habit of mutual dependency. It didn't need to be renewed. It was simply baked into the architecture of global trade itself. That system, though, is undeniably unraveling, one yuan-denominated oil transaction at a time. Economist Zoltan Polshar called this transition Bretton Woods 3. His argument, first made in March 2022, is that the world is shifting from what he calls inside money, paper claims on governments like U.S. Treasury bonds, to outside money, physical stuff like gold and commodities. His punchline was commodities are collateral and collateral is money. When the G7 froze Russia's reserves, it didn't merely punish Russia, it told every non-Western central bank on Earth that dollar-denominated assets could be confiscated, and that changed the calculus permanently. In practice, de-dollarization, as it's been called, looks more like a slow bleed than an outright crash. The dollar share of global foreign exchange reserves has dropped from around 85% in the 1970s to roughly 58% today. Sure, it took 50 years to get to a number that's still nothing to balk at, but that number, it is the lowest point in 2 decades. And here is where all of this might land in your life. The US government currently pays over $1 trillion a year in interest on its debt. That is more than the annual spend of the entire defense and education budgets combined. The number is kept from being even more catastrophic because foreign governments are constantly buying US Treasury bonds. It keeps the bond prices up and yields, and therefore interest rates, down. Mortgage rates track Treasury yields almost exactly. When rates moved from 2.65% to 7.79% between 2021 and 2023, the monthly payment on a $400,000 loan jumped by almost $1,300, putting car payments and family vacations in jeopardy. Now imagine that instead of the Fed raising rates deliberately, the driver is simply fewer countries needing to buy dollars for oil. With fewer dollars needed, that's fewer treasuries purchased. Bond prices quickly fall and yields rise as mortgage rates follow. The Fed can cut the federal funds rate all at once, but it can't force central banks to keep absorbing American debt. And if they stop, that bill lands on you. Chapter 5 – The Final Domino. Every global reserve currency in history has eventually lost that status. Every single one. The Roman denarius, the Dutch guilder, the British pound sterling, each one was, in its era, the operating system of global commerce, and each one fell when the underlying economic logic that made everyone want that currency slowly stopped being true. Reserve currencies have the same problem as bad software. Everyone knows a better option exists, but switching is a pain, so you keep on running the old version until you absolutely can't anymore. When Britain finally lost reserve currency status, it didn't go quietly all at once in a big apocalyptic bang. It went through decades of inflation, emergency bailouts, and a standard of living that steadily declined relative to the rest of the developed world. The pound just slowly became less and less relevant. British citizens absorbed the cost in ways that never quite showed up on a single front page. That is the template for the dollar today. The US is not Britain in 1945. The dollar is vastly more embedded in global finance than sterling ever was. But the pattern is the same. Build global demand for your currency and then watch that demand erode. Britain did it through empire. America did it through oil. Now that system is being routed around. BRICS now represents almost 36% of global GDP and 44% of global oil production. The bloc includes most of the world's largest oil producers. Inbridge works, CIPS, China's alternative to SWIFT, connects 109 countries. India is buying Russian oil in yuan and rupees. Brazil and China ditched the dollar in their bilateral trade. Saudi Arabia is conducting transactions on mBridge while simultaneously declining to formally join BRICS. It's exactly the kind of strategic ambiguity a country maintains when it's keeping its options open. None of these systems are the dollar. None of them replace SWIFT on their own, but the dollar didn't take over the world overnight either. It won because for decades the rules were simple. The world runs on oil and oil is priced in dollars. So if you wanted energy, you needed dollars. That's the part that's starting to crack. America's $39 trillion in debt only works because the rest of the world keeps needing dollars. The real question isn't whether China builds a perfect alternative. It's what happens when the world decides what it's built is good enough and starts moving those trillions somewhere else. Because if that shift actually begins, it doesn't stay contained to currency markets. It spills into interest rates, asset prices, and eventually real life. And at that point, the system doesn't slowly adjust. The world is on fire, and nobody is looking where it really matters. Every headline screams about the Middle East, chaos, and global fear. The media wants you glued to the Strait of Hormuz and the rising price of oil. But it's a lie, a distraction. The real story is in Japan. In 2024, after 17 years, the planet's biggest creditor ended its era of free money. The engine of the global economy is sputtering in Tokyo. And if you have a mortgage, a savings account, or a 401k, you're in the crosshairs. Chapter 1. The Demographic Black Hole. On the surface, Japan looks like it's already living in the future, a place where tech giants dominate the world stage, robots share the streets with people, AI predicts what'll come next, and entire cities run smarter, cleaner, and faster than anywhere else. But look past the distractions, dim the neon signs, forget the shiny gadgets. Focus instead on the finances, the numbers. That's where Japan's deepest, darkest, most disturbing secrets lie. The demographic death spiral. Because in 2026, Japan's population officially sits at approximately 122.6 million people. That might sound like a lot, but in 2010 it was even higher, 128 million to be precise. Since the late 2000s, Japan has been on a steady, unrelenting decline. It's losing around 500,000 people from its population every single year. That's like the city of Atlanta vanishing every 12 months. To make matters worse, Japan also has the highest proportion of elderly citizens anywhere in the world. In 2014, close to 26% of the population was over 65. By 2022, that increased to more than 29%. The population is getting older while the birth rate is hitting its lowest level in more than a century. Fewer and fewer people are choosing to start families. Birth rates are falling. Meanwhile, the number of people of working age keeps shrinking. It's reached the point where now there are 2 deaths in Japan for every birth. That is a problem for a lot of reasons, especially for the economy. Every year that these trends continue, Japan's tax base disappears bit by bit. With more retirees, fewer families, and fewer people paying taxes, Japan's financial foundations are starting to crack. But the Bank of Japan saw this problem coming, and they acted in a way that was desperate, dramatic, unprecedented. They made money free. Instead of raising interest rates to fight the problem, they kept them at zero. At times, they went below zero. At the same time, trillions of yen were pumped into the system. The Bank of Japan became one of the biggest buyers of its own stocks. In effect, it socialized its stock market just to keep the lights on. It was a gamble, one with a massive amount of risk attached. No other central bank of any major developed nation around the world operated the same way as Japan's. But somehow the gamble paid off, at least for a little while. People and businesses didn't have to worry about paying back much more than they'd originally borrowed. Loans became almost irresistible. Families took them. Businesses took them. Everyone wanted in. Why wouldn't they? It was almost like free money. Wall Street hedge funds and investment firms took advantage too, but on a much bigger scale. They realized they could borrow huge amounts of the Japanese yen at 0% interest and convert all of that cash to dollars. They would then use that cash to buy US tech stocks, treasury bonds, or anything else they wanted. It was known as the yen carry trade, and it was like some sort of video game infinite money glitch, a seemingly foolproof way to guarantee returns. For a while, Japan retained its status as an innovative, pioneering, and world-leading nation, in more ways than one. But as gamers know all too well, glitches get patched. The system couldn't last. The so-called stability it provided was, in actual fact, little more than just a band-aid slapped hastily over a gaping hole in a broken economy. It was only a matter of time until that sticking plaster began to peel away. Private investments went nowhere, wages stalled, public debt spiraled, reaching a staggering 260% of the country's gross domestic product, or GDP, by 2022. Soon, the Bank of Japan was running out of options, so they went further, much further. They forced 10-year government bond yields to stay at zero. The country was borrowing at home for nothing and then exporting those profits around the world, hoping that the inflation would never rise too fast. But in 2026, that gamble is coming to an end. Now Japan is left with an incredibly big bill to settle. First, we want to thank the sponsor of today's video, Incogni. Have you ever searched your own name online and found way more than you expected? Your home address, phone number, email, even information about your relatives can end up on people search sites and data broker databases. And once that information is out there, it can be used for phishing scams, identity theft, harassment, or worse. That's why I decided to try Incogni. Getting started was simple. I created my account, selected whose personal data I wanted removed, and gave Incogni permission to work on my behalf. From there, Incogni contacts data brokers for you, sends removal requests, deals with the objections, and keeps you updated along the way. What I really liked is the dashboard, because it makes the whole process feel real. You can actually see the requests going out and track the progress over time. And after more than a week, it's much easier to see just how much work Incogni is doing for you behind the scenes. This feels especially important right now because major data breaches keep exposing personal information, and that data can be used to make scam emails, calls, and texts seem that much more convincing. I recently got one of those text messages saying a package couldn't be delivered and that I needed to click a link to fix it. And because I was actually expecting a package, it looked way more legitimate than it should have. That's the problem with having so much personal information floating around online. Even one profile left up can create real risks. Incogni also has a new custom removals feature on the Unlimited and Family Unlimited plans. So if you find your information on specific people search sites or another website, you can flag it, and one of Incogni's privacy agents will handle the rest for you. Go to incogni.com/TIS and use code TIS for an exclusive 60% off. Again, that's incogni.com/TIS, code TIS for 60% off. Chapter 2. The Widowmaker Detonates. The Bank of Japan had hoped that it would never come to this, and for years it didn't. Crisis after crisis hit, and somehow it held. But anyone watching closely knew it couldn't last. It was never a question of if the bubble would burst, only when. A bomb had been planted, we just didn't know how long the fuse was. Now we do. The explosion is here, and the spark that started it all was rising costs of oil and energy. In 2026, crude oil prices have surged by close to 50%, and it's having an impact all over the world. For a resource-poor nation like Japan, rising rates are a death sentence. As prices rise, central banks of countries all over the world have been forced to take action. In the US, rates still sit at 3.75%. It's a similar story in the UK and across Europe. But elsewhere, the pressure is building. Interest rates passed the 4% mark in Australia, 5% in India, and even close to 7% in places like Mexico and South Africa. And in the middle of all of this, Japan was trapped. On the one hand, it could raise rates but basically bankrupt its own government. It carries the highest debt-to-GDP ratio of any nation in the entire developed world. Or it could keep rates at 0%, but sacrifice the value of its currency in the process. Neither of these options was attractive, but the Bank of Japan had to pick one. It decided to persist with its 0% rate, and the results have been catastrophic. The yen has effectively gone into freefall. 5 years ago, in 2021, the yen was sitting at less than 110 to the dollar, but by late 2022, it was approaching 150. In April 2026, it's close to the 160 mark, hovering near its weakest point in decades. In just a few years, the Japanese currency has lost more than 30% of its value. For businesses, families, workers, it was devastating. Before they knew what hit them, salaries and savings were slashed. The money they had spent years earning was suddenly worth far less than it had been just a few years ago. It's just one of the ways the Japanese public has suffered. The cost to import goods to the country has also skyrocketed, leading to higher prices for numerous products and services. The more the Bank of Japan waited, the worse the situation would become. The yen would continue to spiral. They couldn't allow their own national currency to become worthless. They had to act. So, in a state of panic, policymakers made a decision almost 20 years in the making. They raised interest rates to 0.75%, with plans to increase them all the way up to 1% by 2027. It might not sound like much, and in isolation, it isn't. But compare it to the rest of the world, the US, the UK, Australia, rates of 2, 3, or 4% aren't uncommon. A rate of just 1% would actually be something of a freak occurrence. But for the Japanese financial system, 1% or even 0.75% is a seismic amount. It means that 17 years of free borrowing and free debt are coming to an end. And that doesn't just impact Japan and its people, it affects the whole world. For years on Wall Street, there was one investment strategy everyone had heard of. A strategy built on shorting the Japanese government bonds, betting that prices would fall and yields would finally rise. A gamble against decades of history, a bet that the Bank of Japan would finally break its own trend after years of stubbornly holding 0% interest. They called it the Widowmaker, and the name wasn't just for show. So many people who used this strategy ended up losing enormous amounts of capital because the Bank of Japan never did what they wanted it to do. It continued to maintain near zero or even negative rates year after year. But in 2025 and continuing into 2026, that all changed. The Widowmaker paid off. Trillions of dollars borrowed at nearly 0% in Japan have been flowing around the world, and now they're starting to seep away. The hedge funds and investors who were on the right side of the bet are making a fortune. Meanwhile, banks and firms that borrowed yen at 0% and poured it into risk assets or treasuries are scrambling to cash out while they still can. But while the top gets richer, the bottom pays the price. Everyday people, families, workers, and those who had no hand in the gamble are the ones footing the bill. Chapter 3. The Great Repatriation. This is the final nail in the coffin, the part that the media won't explain. They don't even want people to know about it until it's already too late. An event that is both catastrophic and almost invisible. A crash you won't see coming, but one that will shape the economic future of not just Japan, but the United States and dozens of other countries around the world. A shockwave that could be felt for years, even generations. The repatriation of the yen. The wealthiest and most important Japanese investors, including mega banks, pension funds, and insurance companies, are some of the biggest foreign holders of American debt. As a nation, Japan owns a whopping $1.2 trillion in United States treasuries. To put such an astronomical figure into perspective, $1.2 trillion is enough to fund the entire U.S. military for around 18 months. It's enough to end world hunger several times over. It is an insane amount of money, or to be more exact, an insane amount of American debt, all held in the hands of a single nation in a different continent. For years, it made sense for Japan's institutions to hold that debt. The Japanese Government Pension Investment Fund, or GPIF, is the world's biggest pension fund and has historically held on to a massive amount of foreign bonds. U.S. Treasuries made up 51% of its foreign bond portfolio in March 2025. There was a logic to that decision. U.S. bonds paid interest, while Japanese ones paid nothing. But now that logic is being washed away by the rising tide of Japan's interest rates. As those rates draw closer to 1% and the 10-year Japanese government bond yield surges past 2%, the math has been flipped. Why should a Japanese institution or pension fund like the GPIF continue to run the risk of holding America's debt while it could invest in its own government bonds instead? These companies, these banks, these pension funds no longer have the same incentive to chase returns abroad. Domestic investments finally pay off, and it doesn't take a financial genius to see the obvious. It is time to sell. We found data showing a quiet but growing exodus. Japan is cashing out. It's selling off its assets, dumping U.S. Treasury holdings at a record rate. That doesn't mean the entire $1.2 trillion will disappear overnight, but billions are starting to evaporate, and those billions can quickly turn into tens or hundreds of billions as the weeks go by. The ripples won't just stay in Japan. They'll spread across markets, across borders, across the Pacific. Because when the biggest buyer of U.S. debt bows out, who steps in to fill the void? The simple answer is no one, at least not at first. To attract new buyers and convince the world to absorb the debt, the Federal Reserve will be forced to act. Rates will have to go up, and when that happens, everything else is affected. Mortgage rates climb, credit card interest rates soar. You're suddenly faced with spiraling costs. Everything becomes more expensive, spending power diminishes, and disposable income vanishes. Meanwhile, the stock market starts to bleed. Government bonds are far more attractive than risky bets like tech stocks. Money begins to move fast. For years, the yen carry trade was the grease in the wheels of the entire global financial machine. It kept everything running smoothly. It allowed those Wall Street hedge funds to borrow billions and pump it all into big businesses across America and beyond. Now those same funds are seeing their borrowing costs explode. They're backed into a corner, and they're running out of options. They're forced to sell their most profitable positions. Shares in companies like Apple, Nvidia, Microsoft, they're all dumped just to cover spiraling yen debts. This is the invisible crash. It doesn't dominate the headlines, it doesn't involve mass panic at the New York Stock Exchange or vast crowds of people protesting in the streets. It happens quietly in the background, and the world has no idea. Chapter 4: The Sovereign Debt Trap. We've reached a critical point in history, something the global economy has been building toward for nearly 20 years. And at the center of it all is Japan. It's pinned between two outcomes, both dangerous, both unavoidable. It is the ultimate sovereign debt trap. It either keeps interest rates low and protects its debt, but watches its currency collapse and its country starve, or it raises rates and temporarily saves its economy, but it sets its own national debt on fire, as well as detonating the entire global bond market. There is no out, no alternative option, no last-ditch magical solution. The fuse was lit a long time ago, and now it's reached the powder keg. The yen is just the first domino to fall, but it won't be the last. The dollar is next, and when that begins, everything changes. In early June 2026, Bitcoin plummeted below $60,000. People panicked and sold up. It seemed like the crypto dream was dead. But while retail investors were losing their life savings, Wall Street was executing the largest wealth transfer of the decade. Because this wasn't a crash, it was a robbery. A deliberate move designed to flush out over $1.8 billion in leverage. Friday, June 5th was one of the most dramatic days the crypto markets had seen in years. It happened so fast that most traders barely knew what was going on. Bitcoin, the premier cryptocurrency, which had been trading above 80,000 only a few weeks prior, experienced a sudden, colossal collapse. Millions of cell phones vibrated simultaneously across the world as the news came in. BTC's value was taking a nosedive. It even dipped below the $60,000 mark to reach a $59,100 intraday low at one stage. It managed a minor recovery, hitting $61,000 the next morning. But it was chaos, a market failure, at least to the untrained eye. It seemed like the definitive piece of proof that critics of the crypto world had been waiting for, a clear sign that Bitcoin and crypto in general can't be considered a safe and secure store of value. But here's the truth. This wasn't a failure or uncontrollable crash. It was a controlled burn. A burn that was perfectly executed, mathematically precise, and absolutely necessary for the market to not just recover, but to reach whole new heights. It was the financial equivalent of setting fire to a diseased forest so that healthier roots can take hold. Because while most people were focused on the price charts, they were only seeing the smoke. The real fire was happening behind the scenes. Approximately $1.8 to $2.5 billion worth of toxic leverage was utterly incinerated. Here's why that matters. Leverage is like a plague on the financial system. It's borrowed funds. It's retail traders effectively betting with money that isn't theirs. That in turn forces the system into shaky ground. The more the leverage builds up, the more unstable the situation becomes. Eventually, it reaches a point where the market can no longer move, grow, or progress until that leverage is wiped out. In other words, for Bitcoin to take the next step in its evolution, for this crypto rocket to surge, the leverage had to be jettisoned. But that money can't just vanish, it has to go somewhere. While terrified users were frantically smashing the sell button as they feared the worst, the entities buying up their assets weren't amateurs or casual investors, they were pros. Wall Street investors who took advantage of the fire sale, snapping up assets at a massively discounted rate. They were confident that they would double or even triple their money on the other side. The retail market provided exactly what the big dogs of the investment world had been waiting for: exit liquidity. Everyday investors became fuel for the machine. They thought that they were fleeing a sinking ship. In reality, they were handing over their hard-earned portfolios to giant investment firms. But this crash didn't start in the crypto markets. It started in Silicon Valley. Money is the oxygen of the market. When it flows in, assets grow stronger and more valuable. When it leaves, they become weaker. And in the weeks and months building up to June 2026, one sector in particular was sucking up almost all the oxygen available. That sector was artificial intelligence. In just a few years, AI has infiltrated almost every aspect of modern life. It's become one of the most powerful technological forces on the planet. And where there's power, there's value. Investors didn't want to miss out on making the most of that value. They had to get in on the ground floor of the biggest and best AI companies, as well as emerging up-and-comers, to maximize their long-term gains. 2026 has seen numerous big AI brands making their entry into the markets, with a swath of highly anticipated initial public offerings, or IPOs, arriving on the scene. These are the companies of the future, the masters of machine learning, the creators of the next generation AI models. And unsurprisingly, they attracted a lot of attention. The valuations for some of these companies were almost unprecedented. An unstoppable wave of hype built up and only got bigger as IPO after IPO hit the stock market. The global financial ecosystem responded instantly. Hedge funds and venture capital firms suddenly found themselves in a race against the clock. Some of the biggest tech listings in years were about to hit the market, and everyone wanted a piece of them. But they needed cash fast. You might think that they would start unloading stocks or selling off parts of their real estate portfolios. They didn't. Instead, many turned to the fastest source of liquidity they had available: cryptocurrencies. Slowly but surely, they began draining liquidity out of the crypto markets to pour into AI IPOs. It happened in the background, and bit by bit, the depth of Bitcoin order books began to thin out. The total volume of cash in the world's leading cryptocurrency slowly but surely evaporated. On the surface, the market seemed to be performing as normal. Deep down, however, its foundations were being ripped out. A system with high liquidity can cope with a crisis, but with liquidity drained, the crypto market was a dry forest just waiting for a match to set it all ablaze. And the algorithms knew exactly where to strike. There's a rhythm to financial markets that most people don't understand. They believe that a healthy market should only ever move in one direction, up. Volatility is seen as a weakness, a defect. The best and most successful investors see things very differently. They understand the rhythm of the markets, the cycles, the rises and the falls. They know that volatility is a feature, a necessity even. For any asset class to mature and reach its full potential, it has to pass through periods of structural collapse. It's only by falling that markets learn to rise even higher. The evidence is right there in the data. Not in the price charts that everyone watches, and not in the surface-level metrics that most retail investors obsess over. It is in the deeper macro-level indicators, the kind the world's most sophisticated trading desks use to plan their orders and time their trades to perfection. One of the most powerful is something called the Market Value to Realized Value Z-score, or MVRV Z-score. It sounds complicated, and in many ways it is. Think of the MVRV Z-score as a market alarm system. When it flashes red, Bitcoin might be trading above its fair value. When it moves to the opposite extreme, Bitcoin might be massively undervalued. Take a look at how the Z-score has fluctuated over time, and an astonishing trend emerges. During all of the past big Bitcoin crashes, 2015, 2018, and 2022, the Z-score always did the exact same thing. It dropped below zero, plunging into negative territory. Every time that happened, the media started writing headlines and publishing reports about how Bitcoin was too volatile and dangerous for people to invest in. Some even called the cryptocurrency market dead in the water. Meanwhile, the smallest investors ignored the noise and focused on what mattered, the Z-score. It was a flashing red light and screaming a single all-important order: buy. Because every time that score dropped below zero, Bitcoin rose by at least 300% in the cycle that followed. It's a pattern that's played out over and over. In March 2020, the global pandemic ground the world's economy to a halt. Bitcoin's price was slashed in half within just a couple days. The panic was palpable. But in the 180 days following the massive decline, the long-term holder supply, the total volume of Bitcoin owned by entities that refused to sell, increased by approximately 3 to 5 percentage points. That's the equivalent of taking the entire gold reserves of America off of the open market and moving them to a private vault within 6 months. It was a silent yet massive consolidation of wealth, a dramatic shift of Bitcoin out of weak hands into strong ones. This is a biological necessity of a healthy market. It needs to fail so that it can be reset and rebuilt better than before. And this too is something that we've seen happen in the past with devastating precision. In 2021, Bitcoin was performing well. It reached an all-time high in the $60,000 range by the spring, when suddenly a barrage of bad news sent its value plummeting yet again. Prospective mining bans, regulatory measures, and forced liquidations all took their toll. Within just a few weeks, Bitcoin's price had been slashed in half, sitting in the low 30,000s. The same narrative emerged again. Bitcoin was over. The bull market was dead. Anyone still holding crypto better get out while they can or suffer even greater losses. Large parts of the retail public followed that advice. They sold off their assets and rued the fact that they hadn't got out sooner. But the smartest investors saw what was really happening, a unique phenomenon known as the Wyckoff accumulation phase. Named after a legendary investor, editor, and founder of the magazine of Wall Street, it describes a strategy that many believe the largest market participants have used for decades. Before major moves to higher prices, the biggest players don't usually buy all at once. Instead, they accumulate. The so-called whales do this to frighten retail investors to the point that they sell off their holdings. During the 2021 Wyckoff phase, however, an uneasy anomaly appeared. The number of whale wallets, those holding 1,000 BTC or more, started to decline by around 12%. At the same time, the number of smaller retail-level wallets increased as casual investors bought into the dips in the hopes of turning a quick profit. The narrative shifted to something even scarier. Big money was backing out of Bitcoin. The public once again bought into this story, but the whales weren't really abandoning Bitcoin, they were preparing for a massive leverage wipeout. On May 19, 2021, that wipeout arrived. A staggering $8.6 billion was wiped out within a matter of hours. To understand the magnitude of that value, $8.6 billion is enough to purchase the Dallas Cowboys, one of the world's biggest sporting institutions, outright, and still have $3 billion to spare. The impact was immediate. Retail accounts were liquidated to nothing. This in turn set up the largest wealth consolidation since the 2008 financial crisis. By the end of 2021, Bitcoin's value had surged yet again. Now in 2026, there's enough data to show that this isn't random or coincidental. History is repeating itself with surgical precision. The June 2026 crash is almost a mirror image of the 2021 event. The same headlines, the same narrative, and the same emotional impact on the retail investor market. But 2026 has a safety net that 2021 never had, a floor built by the most powerful financial institutions on Earth. In early 2024, the rules of the Bitcoin market were effectively rewritten. The United States Securities and Exchange Commission officially approved the first Bitcoin exchange-traded funds, or ETFs. For more than a decade, Bitcoin had existed as a separate entity from the global financial system. It was always on the fringes, volatile, lacking in regulatory oversight, and difficult to break into for both amateur investors and even traditional institutions. The launch of the exchange-traded funds, or ETFs, changed all that. It bridged the gap that had separated Bitcoin and the legacy financial system for so long. The impact was immediate. The titans of the investment world like BlackRock and Fidelity jumped into the pool headfirst. By the end of the year, they had held a jaw-dropping 900,000 BTC in their institutional vaults. That's around 4.6% of the entire circulating supply of the asset itself. To put the number into perspective, 900,000 Bitcoin is just 200,000 Bitcoin short of the total of the 1.1 million lost coins of Satoshi Nakamoto, the pseudonymous creator of Bitcoin, worth roughly $80 billion. It's an amount so huge that it holds almost unimaginable influence over the rest of the market. It gives these investment firms enough financial clout to control the very gravity of the blockchain. Wall Street doesn't operate like the rest of the investment world. The biggest players in stock markets, equities, and cryptocurrencies don't trade assets back and forth in the same way retail investors do. They buy assets in order to secure them, and then they build wealth from there. When an institution like BlackRock takes control of a crypto coin, it is no longer in open circulation. As the 2026 crash played out, the media spread sensationalized headlines about massive capital flight. They pointed to the $1.4 billion that flowed out of spot ETFs during the peak of the panic. To them, it could only mean one thing: institutional interest in Bitcoin is dead and buried. But when you look at the bigger picture, $1.4 billion is a drop in the ocean as far as these big mega funds are concerned. In reality, the vast majority of institutional capital hasn't moved at all. It is still exactly where it was before the panic began. And while retail investors were getting cold feet and cashing out, the big dogs like BlackRock and Fidelity absorbed the impact. They didn't panic, they didn't flee, because they understood the structural reality of the market. They knew that in holding the line, they could secure the asset's supply and construct an even stronger floor for the future. But with Wall Street hoarding an ever-increasing amount of supply, the actual quantity of Bitcoin left to buy is starting to vanish. One of the most fascinating things about Bitcoin, and one of the factors that has helped it become such a popular asset among investors around the world, is its scarcity. There will only ever be 21 million coins minted in total. That separates it from the very concept of conventional currency in a major way. No central bank will ever be able to just print more BTC. No political decision will ever be able to expand the supply. And the reality is that Bitcoin is even scarcer than it seems, because a huge number of those 21 million coins aren't available to buy and sell, and they never will be. Why? Because many of them are effectively out of circulation. They're stored on lost hard drives, trapped behind encrypted wallets and forgotten passwords, or held in cold storage and untouched for years. A metric called illiquid supply essentially measures the percentage of Bitcoin that's held by entities which show zero propensity to sell. In 2024, that metric reached an all-time high of approximately 78%. That means only 22% of all the Bitcoin ever mined is actually available for open market circulation. It's like trying to buy a home in a major metropolitan city, in which nearly 80% of the homes can't be sold, ever. If a huge part of an asset's inventory is essentially locked away and removed from the ecosystem, even a minor increase in demand can trigger a violent vertical explosion. The value of that asset rockets up. This is the illiquidity shock in a nutshell. It's like a coiled spring being wound tighter and tighter, just waiting to burst into life and expend all the energy it's accumulated. And this brings us to the ultimate, uncomfortable reality about how global markets actually operate, the truth about who really pays for the bull runs. If you ask the average person on the street what drives a major bull market or who has the biggest influence on an asset like Bitcoin, they would probably point to retail investors. They would argue that it's the ordinary people opening accounts, setting up wallets, and putting a few $100s into crypto every month who drive prices higher. They believe that the public has the power. That is a carefully engineered lie. Retail investors don't drive bull markets. In reality, they provide the exit liquidity for the institutions. And to understand that, you have to understand how institutional order books work. A multi-billion-dollar hedge fund or ETF issuer won't log on to their usual cryptocurrency exchange and buy up tens of thousands of coins in one fell swoop. That would have a massive and violent impact on the market. Instead, these mega funds prefer to expand their investments without impacting the market right away. To do that, they have to trigger a wave of sell orders to match their buys. They basically need thousands of individual investors to sell off their positions at the same time and price point. They need people to panic. That's why the June 2026 crash wasn't a random chaotic event. It was planned, programmed. It was an intentional mechanism engineered by the big investment firms to solve their liquidity problem. It's actually quite simple once you know the basics of how it all works. The same algorithms used by market makers can identify areas where large numbers of stop-loss orders are likely clustered. They know the price levels where retail investors have decided to sell to limit further losses. As the market approaches those levels, even a relatively small wave of selling can push prices lower and lower, bringing them closer to that stop-loss zone. Once the first stop-loss orders hit, a chain reaction begins. A wave of additional orders follows, executing automatically. Huge amounts of BTC are sold off without holders even having a moment to think about their decisions. The price drops further and further still, hitting more and more stop-loss limits in the process. Within minutes, the value has plummeted, and to the average investor watching all of this unfold, they get terrified and they start dumping their coins. When BTC's value has dropped about as low as it can go, the Wall Street investors rush in like sharks, snapping up the coins that have flooded the open market. But it doesn't necessarily mean bad news for retail investors. So far, everything about the Bitcoin crash has seemed like it is rigged against the public. It's designed to chew up retail investors and spit them out, with big institutions playing on their emotions and exploiting their panic. That may be true, but it doesn't tell the full story. To see that, you have to look beyond what's happening at the moment. Ignore the headlines, because the macro models and projection tools used by some of the world's finest financial analysts are all still pointing in the same direction, up. Their forecasts haven't changed, and nor has their optimism. They still believe Bitcoin is destined to go up, far higher, far sooner than you might expect. Most experts agree that Bitcoin should reach $150,000 to $180,000 by the fourth quarter of 2026. But there is no single agreed view. Different models point in different directions, and they change as conditions change. In moments like this, large price moves are usually tied to shifts in liquidity, leverage, and overall positioning in the market rather than any single clear cause. As those conditions unwind, capital tends to move around the system in ways that aren't always visible in real time. Depending on the perspective, this can look like a normal part of market cycles or like a sign of deeper structural stress. What tends to stay consistent is that those forecasts are constantly being revised as new information comes in. And in markets like this, the story is never really about a single crash or a single rally. It's about cycles, how liquidity enters, how it leaves, and how the structure of the market reshapes itself each time it happens. Because in the end, price doesn't just move in one direction or another. It moves through phases, and every phase eventually becomes the foundation for the next one. From insurance scams to credit cards, people are trying to rip you off every day. Want to avoid ending up broke? Pay close attention. I'm Josh, and on today's episode of The Infographics Show, we're revealing the 30 stupidest financial traps that middle-class people fall into. Number 30. According to YouGov, back in 2022, the insurance industry ranks an impressive 4th in the rankings of America's most hated industries, behind only tobacco, news media, and cable. And one of those literally gives people cancer. Part of the reason that people hate the insurance industry so much is finance-ruining grifts like whole life insurance, which can utterly destroy even well-off white-collar professionals. A whole life insurance package, unlike term life, which only covers you for a set number of years, lasts from the moment you purchase it until you die. That's when it pays out a death benefit and maybe even some cash value along the way. It seems like a stable long-term investment. Nope, that's what they want you to think. You're signing up to pay insurance premiums for your entire life, which often ends up costing you 8 to 10 times more than a term life policy, while paying out less when you kick the bucket, presumably from a heart attack after looking at your bank account. And that is just the beginning. Number 29. According to Pew Research Center's 24% of Americans think having a lot of money is the most fulfilling thing in life. Rising living costs and the push to save more have forced Americans to delay retirement and work longer than ever. At least you'll bolster your savings just a little bit more, right? Well, that's another nasty trap the money men are setting for you. The average life expectancy of a person in the US is 79. Work until 65 or later, and you may only have a decade to actually enjoy retirement. Even worse, those years are statistically the most likely to be spent frail and battling serious illnesses. But at least you'll be driving something nice to that job that you can't retire from, right? Well, not if you fall for this next one. Number 28. It's the kind of thing that you dream about as a kid, swaggering into the dealership, buying a new car, and rolling right off the lot. But it is one of the worst things you can do, and it's all because of one word that sends a chill down the spine of anyone interested in finance: depreciation. In your first year of buying a new car, its value will depreciate by 20%, and it keeps on falling as time goes on. It's only considered a new car while it's still on the lot, but the second you drive it off, it is used and priced as such. All that extra money you paid will vanish into thin air. And the worst part? Everyone says buying a used car means inheriting someone else's headaches. But a new car, with all the latest tech and high replacement value, it hits you with an even bigger insurance premium. And just like that, your dream car is now a nightmare. This next trend convinced millions they were getting rich while draining their pockets. Number 27. NFTs, or non-fungible tokens, are blockchain-authenticated, usually ugly little illustrations designed to be unique and randomized. People bought them as speculative investments, hoping that rarity would drive their value up. They were all the rage during the early 2020s crypto craze. But next time you see NFT, it'll save you a lot of heartache if you think of it as meaning not financially tenable. Around 23 million people didn't know this, and they're now sitting on worthless blockchain JPEGs. According to NFT Scan and CoinMarketCap, almost 69,800 out of 73,000 NFT collections have lost all their value, leaving everyone who bought in financially devastated. A perfect example is the NFT of the first ever tweet by founder Jack Dorsey. It sold for £2.3 million in 2021 and reduced to a mere $1,200 in 2023. That is less than $2,000. And if you want to keep your money, maybe hang back the next time you see a crazy speculative investment trend that everybody else is hyping. This next trap is something most Americans are already carrying in their pockets. Number 26. Because everything is so expensive and wages are stagnant, it's not uncommon for people to use credit cards. In fact, 82% of adult Americans have one, often several. And in 2025, America's total credit card debt hit around $1.28 trillion. Many struggle to keep up and just make the minimum payments to avoid late fees. And that is exactly how they get you. The minimum repayment is often only 2 to 3% of the total you owe, but all the while, the interest is still accruing. That means you'll pay more money over time. One source, My Budget, gives this example. If you owe $5,000 on a credit card at 18% interest and you only pay the $100 minimum each month, it could take more than 30 years to clear the debt, by which time you'll have paid over $12,000 in repayments. Over double the original debt. Think about this next time you're making a repayment. And that slow bleed is nothing compared to what's coming. Number 25. The number one commodity in the 21st century is convenience, and companies have realized that they can take advantage of this. What could be a better example of this than food delivery services like DoorDash and Uber Eats? It feels even more practical if you live out in the suburbs. But much like credit card repayments, it's a financial death of 1,000 cuts when you look just a little bit closer. You might think nothing of DoorDashing in your meal when you're tired after work on a Friday night, until you realize that items can be as much as 39% more expensive on these delivery services. And that is before you get the added delivery charge and driver tip. A meal that might cost you $40 if you buy it in the store would be as high as $54 over the app. So if you're ordering in multiple times a week, you are bleeding out and you don't even know it. But that is nothing compared to our next financial trap. Number 24. The lottery. It's like being struck by lightning, except it pushes you into a new tax bracket. Americans are paying big to play a game they're almost guaranteed to lose. Your chances of getting killed in a lightning strike are around 1 in 187,000. Your chance of winning the Powerball are 1 in 292.2 million. It's not even close. According to CNBC, half of Americans play the state lottery, and depending on the specific source, the average American spends between $300 and $1,000 on lottery tickets every single year. That's money you might as well just toss into a wishing well. Needless to say, it is far better left in your pocket. And speaking of dreams, the American dream itself might be one of the most expensive traps of all. Number 23. It's the middle-class dream to actually own your own home rather than renting, and in 2024, mortgage repayments actually were cheaper than rent, which probably has a lot of us considering a call to the Samaritans. However, this comes with another financial trap for owners, and it's one that seems to be getting worse every year along with inflation: maintenance costs. According to Forbes, the annual maintenance cost for a single-family home is approximately $10,400 per annum, with a 5.9% year-over-year increase. Isn't life just absolutely relentless? Even when you've got a dream situation, there are insanely expensive caveats. But homes aren't the only heartwarming purchase that can quietly wreck your finances. Number 22. You may think that pets add a little extra meaning to your life, but they can just as easily be like an anchor around your neck, dragging you down into financial oblivion. Let's look at the most popular pet in America. There are currently 48.3 million dogs living in American households. While the dividends of owning a dog are largely seen as love and companionship, you can't buy a Lamborghini with either of those. So let's look at the real costs of owning one of these four-legged freeloaders. According to the Wall Street Journal, upfront costs for obtaining a dog vary from $1,100 to $4,400. But that is just where it all starts. You've also got spaying and neutering, vaccinations, training, food, routine checkups, grooming, and physical supplies. That adds up to between $3,000 and $9,500. And then it's time for pet insurance. And if you're hoping for more than one pet, feel free to add the appropriate multipliers to all of the numbers here. Now, we're about to talk about lifetime damage. Number 21. Are you a millionaire? We're gonna guess probably not. But did you know that if you're a committed smoker, you might spend as much as $1.6 million on cigarettes over the course of your life? And that stat came out in 2016. Adjusting for inflation over the past decade, you might be looking at as much as $2 million by now. But if alcohol is your legal take-the-edge-off option of choice, that's also going to financially bleed you. The pandemic supercharged alcohol consumption, seeing jumps as large as 20% to 40% in some U.S. states, so business is booming if you happen to be selling it. In 2022, the average American spent $583 on alcohol each year. Even if you shrug off the upfront costs of cigarettes and alcohol, the true price comes later, as their health toll adds up to a staggering global healthcare bill. Better to curb your habits now for your finances and your future, no matter how cool you think you look with that cigar and glass of scotch. This next one locks you in without realizing. Number 20. Netflix, Amazon Prime, Disney+, Hulu, HBO Max, Peacock, and that is still just a fraction of the streaming services that entertainment is spread across these days. And it's all getting more expensive. In fact, Forbes found that streaming packages got 44% more expensive across 2025. The average American is spending just over $42 a month on streaming, working out to just over $500 a year. And are you even regularly watching half of the services you have? It's yet another reason to scale all that back and watch more free infographic show videos here on YouTube. Number 19. Gambling apps are currently causing a financial and health crisis across the US thanks to relaxed gambling laws. People bet on sports, elections, and even random world events, sometimes spending thousands of dollars every year to little or no return. The National Council on Problem Gambling estimates that about 2.5 million adults in the US have severe problems. Another 5 to 8 million have significant issues. If you find yourself as one of those people, it might just cost you everything. And just when you think you've avoided the obvious traps, there are contracts waiting for you dressed up as opportunity. Number 18. A rare method of getting a foot on the property ladder is a rent-to-own deal. This lets you build equity with each rent payment until you fully own the home. But while it seems like a sweet deal, there are some major financial traps that you need to watch out for. With a shady seller, your payments could be pocketed or used to cover their taxes and mortgage, passing the debt on to you. In extreme cases, they might even rent or sublet the property, pocketing extra money while you're getting nothing. If you enter a rent-to-own deal, do your homework first. It couldn't get worse, could it? You bet it could. Number 17. What's more middle class than having a boat in your driveway? While it's a status symbol for many, it can also become a major financial sinkhole. Not only do boats depreciate in value just as bad as cars, it can be an expensive hobby. Boat insurance can be costly, and maintenance costs can be considerable. And if you feel like keeping it at the harbor rather than on your trailer outside of your garage, renting a berth will be an ongoing cost too. And how much are you actually gonna use it? Really? Now for one of the biggest scams for hopeless romantics. Number 16. It's a tradition as old as time, spending 2 months of your salary on a big old diamond ring to propose to your beloved. Except it's not as old as time, it's only as old as 1947, when the De Beers Diamond Company made this the new tradition. Before the 1940s, only 10% of brides were getting diamond rings. By the 1990s, it was 80%. Instead of blowing 2 months' salary on a generic diamond ring, spend a bit less on something personal and don't bankrupt yourself over a rock. And the debt keeps on coming. Number 15. Middle-class people are careerists. They want to get their foot in the door even if it means being financially abused. It's why one of the biggest scams out there is signing up for an unpaid internship. People tell you it's a valuable way to earn experience and build your connections in the industry. But if time is money, you deserve to get paid for your time and hard work. Now for something that shouldn't surprise you. Number 14. Everyone knows they're getting ripped off at the hospital. It's a staple of every hack joke in the universe. Even routine procedures can come with a shockingly high cost, long before major medical debt hits. Here's a little infographic show life hack for you. Ask for an itemized list of charges on your bill, where they'll have to tell you each thing they're charging for. And then you'll see a lot of that bill disappear like magic. And the bills keep on racking up. Number 13. Fashion moves fast, and constantly changing cheap, trendy clothes can cost more than investing in a few quality staples that last for years. Clothes are getting more expensive, with average items costing as much as $17 or more. And that is a problem. New clothes make up 2.3% of the average American's yearly spending. Buy reliable, save money, and reduce clothes waste in the process. Everyone wins. And that's just your wardrobe. Wait until we talk about spending that can haunt you for decades. Number 12. Would you spend $33,000 on a vacation that lasts a single day? Probably not. But people regularly go into debt funding weddings, with that as the average cost, 40% of which is just the cost of the reception venue and the catering. Is it really worth it? We're not saying you shouldn't get married, just that instead, maybe you should go in with a more reasonable budget if you don't want your wallet to be haunted by a matrimonial ghost for years to come. All of that debt will be with you until death do you part. And even then you can't escape. Number 11. One of the darkest financial traps that people fall into is dying. And as it turns out, death is insanely expensive. According to the University of Pennsylvania, if you or a loved one died of a long illness, the last month of your life in hospital can already cost as much as $32,400. Actual burial costs can be around $7,800. And you'll save a little bit of money with cremation at $7,000. And when it comes to settling the legal matters of the deceased's property, you're also looking at a few thousand more. Even death can't help you escape from capitalism. But check out what's happening when you're alive. Number 10. Buy now, pay later plans allow you to finance purchases and pay them in installments. It seems like a pretty sweet deal. You can even do it on PayPal. But there is some darkness beneath the surface. Some of these legal services offer credit limits of $30,000, and that money is easy to abstract. Even if you manage to get an interest-free deal, if you miss a payment, you'll find yourself in a world of financial hurt until you're old. And when you're old, new financial traps await. Number 9. Age comes for all of us eventually, and it leaves us supporting ourselves or supporting elderly relatives. And in this predator system we call America, that can lead to a pretty brutal financial trap. At the high-end retirement homes, the median cost of care is $5,900 per month, but ancillary services can make that rise to $20,000 per month. And even this doesn't necessarily guarantee you a good standard of care. It can be a brutal industry and a sign of the fact that our productivity-obsessed society casts away the elderly on our dime. Most people won't see this one coming until it's too late. Number 8. Health insurance is another one of those traps that you sadly can't really avoid, given that your life and well-being is being leveraged against you for it. You'll be paying monthly premiums for health insurance in case you get sick or injured, but a lot of the time you're actually paying more and getting less. Healthcare providers negotiate higher prices with insurers than if you were just paying in cash. Isn't the system wonderful? Number 7. Call it a cliche, but if a deal looks a little too good to be true, it almost definitely is. Throw in some cash and someone promises to quadruple it quickly? Well, you might just be staring down the barrel of what experts call a high-yield investment program, or HYIP. These unregistered investments will offer shocking payouts, the kind that would scare away any savvy investors and leave only the juiciest of rubes. And soon they'll be parted from what little money they can spare. If someone's offering you a once-in-a-lifetime investment opportunity, do your due diligence, or you might never invest again. Think you're safe from fraud? Think again. Number 6. As the economy worsens, people look for ways to ease the pinch, and that is when payday lenders creep in. Increasingly, middle and upper-income individuals seeking quick cash end up leaping straight into this financial blender. Even with a loan of $500 to $1,000, with a 300 to 500% annual interest rate compared to the 15 to 30% APR you'd get with an average credit card, you are soon going to be in some real trouble. Avoid payday lenders at all costs. Number 5. At the risk of sounding like your drunk uncle at Christmas, you really want to be careful who you're married to. It could be the worst decision of your life. Divorce is a booming industry, raking in around $50 billion every year. How much you could get annihilated for in a divorce will depend on your personal net worth and the peculiarities of the split. That's not our business. But in general, the median cost is $7,000 and the average cost is between $15,000 to $20,000. And that is before you even get into property disputes and child custody. But there's another seemingly innocent and quintessentially middle-class decision that can financially haunt you for the rest of your life. Number 4. Going to college was once a rite of passage for everyone in the middle class, but these days, with a population more educated than ever, a degree isn't worth what it used to be. In a metaphorical sense anyway, because in a financial sense, it is more expensive than ever. According to the Education Data Initiative, the average U.S. cost for attending university is just under $38,300 per student per year, including books, supplies, and daily living expenses. Kind of like owning 10 pets with severe health problems all at once. And then comes the student loan debt. 42.3 million Americans are shouldering a total of $1.81 trillion in debt. The average loan debt works out at almost $39,400, but thanks to the beauty of compound interest, you might just be paying it off until your whole life insurance plan pays out. Still, there are 3 financial traps that are even stupider and even worse. Number 3. Take every financial trap of traditional college, double it, and then add the risk of a near-worthless degree, and that's the reality of for-profit colleges. These private institutions cut costs on teaching because the proceeds go straight to the owners. Students at these schools default on their exorbitant loans twice as much as people who attend regular college. According to The Guardian, from 1995 to 2015, enrollment at for-profit colleges went up more than 460%. They promise a lower barrier to entry as a smokescreen for shoddy teaching, bunk diplomas, and hidden costs. Avoid them like the plague. Here's where things get really serious. Number 2. Ever wanted to be your own boss? Plenty of people do, hoping to escape the rat race and forge some financial independence. And multi-level marketing companies, or MLMs, prey on that exact feeling. MLMs are sales companies that recruit you, sell you the supplies for you to sell on, and then encourage you to profit by recruiting new salespeople into your downline. Essentially, they're predatory companies that sell the concept of selling. Some of the worst of these companies are literally illegal pyramid schemes that will land you with a garage full of surplus products and plenty of open space in your bank account. They'll make lofty promises about the huge amount of money that you could earn with them, but you'll only be able to turn a profit if you turn predatory too and start dragging more unfortunate folks into the scam. According to Gerard Brody, chairperson at Essential Services Commission, there is literally a 99.7% chance that you will lose money. Almost nothing but tomorrow's sunrise is that certain, so stay away at all costs. Now, for the ultimate financial trap. Number 1. When it comes to scams that will suck you absolutely dry, nothing beats the utter nightmare that is the timeshare deal. It's essentially a shared vacation home. You use it for part of the year, others use it for the rest, so the cost is theoretically lower than renting a place you'd only visit occasionally. The problem is, predatory management companies use this as a way to lock you into a contract that favors them. Meanwhile, they absolutely ream you on property maintenance and management charges that they have been known to ramp up whenever they want. And while they're sucking your bank account dry, you will barely use the place since you and every other buyer are fighting over the same peak vacation weeks. Everyone loses while the timeshare companies are cleaning up. If someone tries to sell you a timeshare condo, turn around and run for the hills. You've been told the Federal Reserve controls your interest rates. That's a lie. Your mortgage, your car loan, and your 401k are all tied to oil-rich nations in the Middle East. America's economy depends on a deal most people never knew existed. None of it is secret, most of it is on the public record. Almost none of it was ever put to you. Chapter 1. The 2026 Mortgage Spike. In March 2026, the average 30-year mortgage rate climbed by 13 basis points. It's the biggest weekly jump in nearly a year. Eventually, it hit its highest level since September 2025. Just 3 weeks later, rates surged again, this time by 34 basis points. Mortgage applications fell 10.5% that same week. Refinancing fell off a cliff. It wasn't for the usual reasons. The Federal Reserve hadn't raised rates. Inflation data hadn't suddenly exploded. Instead, war tensions abroad were pushing Treasury yields up. Mortgage rates were dragged along with it. So how does conflict on the other side of the world change the cost of buying a house in America? Behind the scenes, a small number of foreign governments hold enormous amounts of U.S. debt. When one of them suddenly needs cash, there is a simple way to get it: sell treasuries. When a major holder starts selling into a volatile market, treasury prices fall and yields rise. American mortgage rates are built on top of those yields. When long-term bond yields climb, 30-year mortgage rates usually climb with them. Banks price home loans off of that bond and then add their own cut on top. None of this is hidden, it's just rarely said out loud. The numbers behind it are bigger than most people realize. The Federal Reserve Bank of Kansas City estimated that a single month of roughly $141 billion in foreign treasury selling could push U.S. yields up by about 57 basis points. Other estimates range from 25 to 100 basis points. A separate study in the Journal of International Economics puts the impact of a $100 billion sale at around 100 basis points within a month. Put that on a median new American home today. A 50 basis point jump adds about $130 a month to your mortgage, every month for 30 years. A 100 basis point move roughly doubles that, north of $260 a month. Over the life of that loan, it adds up to tens of thousands of dollars, all of it paid out of one family's future. And the pain does not stop there. Home equity is the biggest pile of wealth most middle-class families ever touch, and when their rates shift, it starts to chip away at it. The house stops rising in value, while the cost of keeping it climbs. That is wealth thinning in slow motion. Higher rates also halt new construction and renovations. Projects get delayed, jobs on framing crews, electricians, and contractors disappear. The slowdown doesn't stay in housing, it spreads outward. Car loans get more expensive, student debt becomes harder to refinance. Even small business credit lines start tightening in towns that have nothing to do with global bond markets. All from one shift in a distant market. One thing can send a shockwave through the entire system before most people even realize anything has changed. Chapter 2. The Invisible Pawn Shop. The Fed uses a system called the FIMA Repo Facility. FIMA, or FIMA, stands for Foreign and International Monetary Authorities. Let's say a foreign central bank owns U.S. Treasuries and suddenly needs dollars. It can bring those bonds to the Fed, hand them over as collateral, and then walk away with cash. It's a short-term deal. It gets bonds back when the trade is reversed. Essentially, it's a pawn shop for entire countries. But it was never meant to be a permanent system. The Fed set up a temporary FEMA repo facility on March 31, 2020, during the COVID pandemic. It was supposed to run for at least 6 months. It was extended again and again. On July 28, 2021, the Fed made it a standing facility. There was no debate or vote, it just became a thing. The pricing was set deliberately high, 25 basis points over the interest rate on excess reserves. That rate is on purpose. It sits above private market rates when conditions are calm. So nobody uses the Fed's counter when markets are healthy. The open market is cheaper and easier to deal with. A central bank only uses it when selling would be worse than paying the Fed's markup. In other words, it only gets used when doing anything else would make things worse. For years, the Fed has been fighting inflation and making loans harder and pricier. But at the same time, the Fed is ready to hand dollars to foreign central banks. One move squeezes the American borrower. The other ensures that if a foreign holder needs help, there is always a backstop waiting. Critics say it creates a death loop. When a market knows there's always a safety net for its biggest players, pricing stops being honest. Price discovery is the whole point of a market. It's how everyone learns what a thing is truly worth. Markets don't move on just data. They move on what people believe will happen when things break. And that's the problem. Emergency tools are supposed to be the backup, the last resort. They only exist for rare moments of stress. But if they keep getting used, rare stops meaning rare, and it becomes a part of the system. FEMA became necessary because the normal buyers of U.S. debt stopped doing their job as reliably as they once did. But the warning signs were there. Chapter 3. The Warning Nobody Watched. On September 17, 2019, the repo rate, the rate that banks pay to borrow cash overnight against safe government bonds, suddenly spiked. It went from about 2.4% to over 5% in a single day. At one point, it briefly touched the double digits. For a market that rarely moves 20 basis points in a session, that's a warning sign, and nothing big had happened. The cause was boring. Corporate tax payments drained cash out of the system at the same moment that a large Treasury settlement pulled even more liquidity away. Roughly $120 billion vanished from available reserves in a single day. The institutions that normally smooth these gaps didn't step in fast enough. Not because they were in trouble, but because the rules and incentives after 2008 made them more cautious about doing so. The New York Fed responded within hours. It injected $75 billion and repeated the operation every day for the rest of the week. This is where the Fed drew a line. Cash drained out in predictable ways: tax payments, Treasury settlements, normal events. But there wasn't enough of a buffer left in the system to absorb them. Nobody in charge could confidently say where the safe level actually was anymore. So 2 years later, in July 2021, the Fed made it permanent. It turned its emergency repo actions into a standing repo facility for U.S. banks. This was a standing promise to step in and lend cash whenever private markets wouldn't. It was the same day it created the FEMA facility. One domestic, one global. Both built for the same reason, to make sure liquidity stress could never again spike the system like it did in 2019. And this became the template for everything that followed. Chapter 4. The Japan Pivot. For a long time, Japanese institutions were among the steadiest holders of American government debt. They were reliable enough that markets treated them as part of the furniture. The thing pulling Japanese money across the Pacific was a trade called the carry trade. Japanese rates sat near zero for years. Investors could borrow yen for almost nothing, convert it to dollars, and then buy higher-yielding U.S. assets. The difference became the profit. For years, huge amounts of capital flowed through that single trade. It didn't feel like speculation in the usual sense. Money moved so consistently it stopped looking like movement at all. It worked like a hidden stabilizer under the whole treasury market. And that all changed in 2025. The Bank of Japan stepped away from its long era of super loose policy. It raised its policy rate in stages. By December 2025, that rate sat at 0.75%, the highest in 3 decades. The increment looked small, but its effect was not. A carry trade only prints money while the borrowed money is free. The moment the yen stopped being free, the gap that justified the trade started to close. Even worse for Washington, Japanese bond yields were rising at home, above 2%. Japanese investors suddenly had a reason to bring their money back. They could earn a safe return in their own currency. Money that had flowed out for a generation began to turn around. Japan's pullback arrived while U.S. debt issuance was setting records. At that exact moment, Washington needed to sell more debt than ever, and one of its most reliable buyers started stepping back. That doesn't trigger an instant crisis, but it changes the balance underneath the system. Because when a borrower suddenly needs more money while a longtime lender buys less, the stress has to go somewhere. The foreign slowdown wasn't even the full problem. While that cushion was thinning overseas, another pressure point was quietly building inside the United States itself, one large enough to matter on its own. Chapter 5. The $1 trillion Maturity Wall. Washington is not the only borrower in America living or dying by the refinancing window. Underneath the federal numbers sits a second debt pile. Most people never think about it until it lands on them: commercial real estate. From the office block downtown to the strip mall off the highway, almost none of it is financed with loans that pay themselves off over time. Those loans come due in full. Nearly $1 trillion in property loans were scheduled to come due in 2025 alone. Hundreds of billions more were stacked right behind them in 2026. That means well over $1.5 trillion in debt suddenly has to be refinanced into a completely different world. A building financed years ago at 3% now has to roll into a loan that costs dramatically more, while the building itself may be worth dramatically less. For many properties, there isn't enough income left to make the numbers work anymore. So, lenders lean on a move called extend and pretend. And it's exactly what it sounds like. Banks extend loans and push the deadlines out for another year or two. They avoid locking in the loss today, and they hope conditions improve before the problem comes back around. Individually, every step sounds reasonable, but across the entire system, those delays start piling on top of each other. A refinancing wave that large, hitting that fast, is enormous. It's a debt on the scale of an entire mid-sized country's economy suddenly needing new terms all at once. Except this isn't some distant sovereign crisis, it's American real estate. Much of that debt was written in a completely different era when rates were low and property values were far higher than they are now. Some sectors got hit harder than others. 35% of hotel mortgages and 24% of office mortgages came due in that single year. Offices have an extra problem. The working world stopped using them during the COVID pandemic, and working from home became the new reality. Fewer workers came back and the buildings emptied out, so naturally their values fell. Now, the loans are coming due against properties worth less than when the debt was originally issued. Hotels have a similar problem. Their revenue swings with travel demand and conference budgets. Both shrank. That pressure does not stay inside of real estate. It moves directly into the banking system, especially smaller regional and community banks. They tend to hold huge amounts of commercial property debt on their books, and those are the same banks many small businesses rely on every day. A bank carrying quietly stressed property loans becomes more cautious. Lending tightens, small businesses struggle to expand. First-time home buyers get squeezed harder. This is where the pieces start connecting. Earlier, foreign demand for U.S. debt began thinning out. Now domestic credit is tightening too. Two separate pressure points start pushing against each other. And because the losses haven't fully surfaced yet, the system enters a strange state. Everyone knows the stress exists, but nobody wants to be the first to fully price it in. Banks extend the loan or rewrite the terms. They can give the borrower more time. Technically, the loan can still look current on paper because payments are still being made under the new agreement, but the losses don't vanish. They just sit there, quietly accumulating until the system runs out of room to keep postponing them. Chapter 6. The Dollar Liquidity Squeeze. The Gulf runs on a steady current of American currency. Oil is priced in dollars. Export money returns in dollars. Sovereign wealth funds are all measured in dollars. When the Iran war broke out in late February 2026, the conflict had a global impact. The closure of the Strait of Hormuz choked off the flow of roughly a fifth of the world's oil. Oil prices rose and inflation expectations rose with them. Treasury yields and mortgage rates followed. As instability spread through the region, governments across the Gulf started pulling harder on dollar liquidity. These countries are usually portrayed as the lenders, the cash-rich powers buying skyscrapers, sports teams, and stakes in companies all over the world. But when dollar funding tightens, even they can feel the effects. The countries people imagine as financially untouchable still depend on the same Federal Reserve mechanics as everyone else. When the pressure rises, they need dollar access too, fast, which means the image of total independence was never quite real. It only looked solid while dollar liquidity was easy. And that's when the foreign banks face a hard choice. They either sell a huge pile of treasuries into an already stressed market, but that creates its own problem immediately. Selling pushes bonds down and yields up, which means that the value of the bonds you still own also falls. You solve the cash problem by damaging your own balance sheet. So most don't want to do that unless they absolutely have to, which means they use the Fed's dollar backstops instead. They borrow dollars, post collateral, and avoid dumping bonds into the market. And that decision can ripple all the way into American households. If enough treasuries hit the market all at once, yields rise, mortgage rates rise with them, retirement portfolios get hit too. One liquidity decision overseas can change the monthly payment on a house thousands of miles away. For the foreign banks, it makes sense. Without swap lines or repo facilities, they have no choice except to liquidate treasuries into the open market. And that kind of forced selling can spiral fast, driving yields sharply higher and destabilizing everything tied to them. The backstops exist to stop that chain reaction before it starts, and technically, these arrangements are structured to protect the Fed from direct currency losses. So this isn't a simple bailout in the way that people imagine, but the broader shift is still real, and the repeated use becomes the normal and then is baked into the system. Chapter 7. Who actually holds the debt now? You might imagine a dollar swap taking place in smoky back rooms in Washington. An oil-rich Gulf state storms into Washington, makes demands, and threatens to dump treasuries unless it gets what it wants. That's not how it works. When swap line discussions happen, they're not ultimatums, they're precautions. Countries with enormous reserves want reassurance that if markets freeze or dollar funding tightens, they still have access to liquidity. Kuwait's U.S. Treasury holdings have climbed to records near $66 billion. UAE holdings are in the tens of billions and growing, backed by reserves far larger than that. So this wasn't a case of bankrupt countries begging for rescue. The real purpose of these arrangements isn't necessarily to save the creditor, it's to stabilize the treasury market itself. Because the danger isn't just that a large holder loses money, the danger is that a large holder suddenly becomes a forced seller in a market already struggling. The word precautionary is doing a lot of heavy lifting. It's less about emergency aid and more about keeping major creditors calm enough to keep holding debt. That leaves the United States in an uncomfortable position. If policymakers don't reassure major holders, the risk of panic selling rises. But if policymakers do build permanent reassurance mechanisms, the dependence becomes more structural. The reserve issuer starts managing the conditions under which its creditors remain comfortably financing it. Neither option is especially clean. And once one major holder starts becoming more cautious, the others notice. That's how financial behavior spreads. If one large player starts hedging, everyone else starts asking whether they should too. And that's important because the treasury market rests on a global assumption that has existed for generations. U.S. government debt is supposed to be the safe asset, the foundation underneath everything else. But foundations rarely crack all at once. Usually, confidence erodes gradually. For decades, foreign demand under American debt came mostly from allied central banks. They buy for strategic and monetary reasons. They don't panic sell because one quarter went badly. Now that's changed. In 2024, foreign private investors overtook foreign governments as the largest overseas holders of U.S. treasuries. And private capital behaves very differently. These aren't institutions built to sit still for geopolitical stability or long-term reserve management. Many are asset managers, hedge funds, and leveraged traders running complex treasury and repo trades through global financial networks. Their job is to move when the conditions change, which means the market swapped part of its shock absorber for something much more reactive. Chapter 8. The Great Dollar Backstop. The Federal Reserve has taken on a role it was not originally designed for. It's now a standing source of dollars not only for American banks, but it's also a standing source of dollars for the global dollar system, foreign central banks included. People can argue about whether the Fed expanding its role in global dollar support is good or a form of overreach, but the expansion has happened, and most people aren't aware of how far it's gone. The Fed's total commitment to rescuing the system since 2008 tops $29 trillion. That's enough to pay off the vast majority of the United States national debt in a single transaction. Not $1 of that built a road, funded a school, or made the economy more productive. The purpose was narrower: keep a stressed system from having to recognize its flaws. Every dollar of it bought time, none of it bought a fix. What has thinned across all of this is not money but independence. American prosperity was once close to self-funding because the world wanted the debt freely, and that has weakened. More creditors now rely on official backstops as part of staying in the market, not as an exception, but as something assumed will be there if selling pressure appears. At the same time, the holder base has become faster moving and more sensitive to changes in rates and liquidity conditions. That shift made it harder to rely on private demand alone to absorb the stress. The Fed's backstop is no longer temporary. It's no longer small. The system now relies on two things that cannot be taken for granted: the continued willingness of large holders to hold U.S. debt and the standing presence of central bank support when they do not. And that is not a prediction of collapse, it's a description of the conditions already sitting in the system. And conditions like that don't stay theoretical forever. But let's say the worst does happen. How will the average American cope with a worthless dollar, and who will be left picking up the pieces? People think high interest rates fight inflation by slowing the economy. At least that's the story you've been told, but that is not what actually is happening. For the asset-rich boomer class, high rates don't feel like punishment. They act like a stimulus check, one that boosts disposable income and keeps service sector inflation high. The Federal Reserve didn't cool the economy, they delivered a multi-billion-dollar annual windfall to the wealthiest generation. And you are the one paying for it. This isn't monetary policy, it's a $78.5 trillion demographic heist happening in plain sight. Chapter 1. The $450 billion stimulus nobody voted for. In 2021, a Bureau of Economic Analysis dataset showed American households earning $1.45 trillion in interest income from cash and bonds. By 2024, that total hit $1.9 trillion. That's a $450 billion jump in annual interest income. And that money flows into household accounts every 12 months, with almost none of it requiring anyone to lift a finger. The average NFL team is worth $7.1 billion in 2025, according to Forbes. All 32 teams added together crossed $227 billion for the first time. The interest windfall is about twice that. 1 year of extra checks could buy the entire NFL outright, and you'd still have more than $200 billion left in the bank. $450 billion is bigger than the total annual GDP of countries like the Philippines or Denmark. None of this money required Congress. None of it required a vote. The Fed raised rates and a spreadsheet did the rest. And cash did not get sprinkled evenly. The Fed's own quarterly report on household assets showed that the money flowed into treasury bills, money market funds, CDs, and short-term corporate bonds. Households over 60 hold most of those instruments. When the federal funds rate moved past 5%, those holdings started paying yields not seen since before the 2008 crash. And that's a problem. The Federal Reserve's stated job is to slow the economy by making money expensive. Borrowing should hurt, spending should drop, and prices should cool. That's the lesson every freshman economics student learns. That lesson describes an economy that no longer exists. Young households with 7% mortgages and 24% credit card APRs got the break. Their parents and grandparents, sitting on $1.2 million in T-bills, got the gas. The Fed pressed both pedals at once, and the people with cash won the trade. Service inflation, the kind that you feel in restaurants and cruise tickets and dentist bills, has refused to come down. The reason is right there in the numbers. You can't cool a market when its biggest customers just got a permanent raise. So here's the question: how did a single age group get strong enough to break the basic rules of monetary policy? The answer took 40 years to build. Chapter 2. Rewind. The demographic bulge. The Federal Reserve publishes a data set called the Distributional Financial Accounts. It tracks how American wealth is split between generations, updated every 3 months. As of May 2026, baby boomers born between 1946 and 1964 hold about $78.55 trillion in net wealth. That is 51.8% of everything American households own. Millennials, the largest adult generation in the country, hold about 9%. That is less than a fifth of what their parents own. Every farm, factory, office, hospital, and gas station in the country produced $28.3 trillion of goods and services in 2024. The boomer balance sheet is almost 3 times that. One age group sits on 3 years of total national output. The Federal Reserve has never recorded a concentration like this in the data series, which goes back to 1989. Researchers at the St. Louis Federal Reserve traced the cause to a deeper shift in asset prices. They used a number called the wealth-to-GDP ratio. It compares everything households own to what the country produces in a year. In the early 1980s, that ratio was about 3.6. Today, it's 5.5. The paper value of the things Americans own grew much faster than the actual products the country made. The shift had winners and losers, and the timing decided everything. A couple bought a Cape Cod in Boston in 1985 for $80,000. By 2020, it was worth $600,000. Someone who bought $10,000 of S&P 500 index shares the year Reagan was inaugurated had over $400,000 by 2024. Compare that to a software engineer who graduated into the 2009 job market. By the time they could afford a down payment, the same house cost 10 times the median income. 40 years of asset inflation does not divide evenly by age. It pools to wherever the assets already are. In 1985, that was the boomers. They didn't plan it. They just happened to be in the door before the rent went up. By 2022, when the rates climbed, you could see the result. A huge pile of cash sat in accounts built to benefit from rising yields. Holding $79 trillion is one thing, turning it into an annual paycheck pointed at the working class is a different problem. And that is where this story gets ugly. Chapter 3. The reverse Robin Hood heist. Economists have a polite name for all of this: the interest income channel. The phrase shows up in the Federal Reserve papers and Bank for International Settlements working documents. The mechanics are simple, and they're brutal if you're on the wrong side of it. When the central bank raises rates, 2 things happen at the same time. Borrowers pay more and lenders collect that money on the other end. Every extra dollar of mortgage cost shows up as extra interest income on someone else's statement. Money doesn't disappear, it just changes hands. So who borrows and who lends? The Fed's flow of funds report answers without much room for debate. Households under 50 carry the vast majority of outstanding mortgage debt in the country, with Americans aged 40 to 49 holding the highest balances at $3.4 trillion. Most of the student loans and the biggest credit card balances sit in there too. Their parents and grandparents hold all the cash and the money market positions and the short-term treasuries that pay the yield. When the Fed raised rates from nearly 0% in 2022 to 5.5% by 2023, it didn't slow the economy evenly. It hit the brake on one age group and the gas on another. The total spending change came out close to zero. The change in who holds the wealth was historic. The Fed's main weapon against inflation just broke a 70-year promise. Working hard no longer builds a future. Hundreds of billions in new no-risk cash now sits in older accounts. So what are the holders doing with the money? They're spending it on experiences that didn't used to sell out. Chapter 4. The Luxury Paradox. Royal Caribbean Group reported full-year 2024 revenue of $16.5 billion. Net income hit $2.9 billion, and adjusted earnings per share landed at $11.80. CEO Jason Liberty kept using one phrase to explain the run. He called it strong close-in demand. Analysts used a more descriptive name. They called it the Silver Tsunami. Carnival Corporation told the same story. Fiscal 2024 brought an all-time high of $25 billion in revenue and $1.9 billion in net income. CEO Josh Weinstein told investors the boom was being driven by older customers. They were booking premium cabins on cruise ships weeks before sailing at prices that would have looked insane in 2019. The data behind those earnings is consistent. Travel research from Fodor shows the same trend. Boomers spend nearly 3 times more per trip than Gen Z travelers. They account for 80% of all luxury travel spending in the United States. That figure puts a 4 out of 5 grip on the market in the hands of a single generation. A Royal Caribbean Oasis-class ship holds about 6,800 passengers at peak. The annual dollar volume of boomer luxury travel is enough to fill 1,000 of those ships. That is every cabin, every year, fully booked. It's like a fleet of floating cities stretching from Miami to Reykjavik. The whole thing is funded by interest checks the Fed mailed out. The spending lands right in the inflation data. The Bureau of Economic Analysis sorts consumer outlays into goods and services. Hotels, cruises, restaurants, premium healthcare, and travel all sit in the services bucket. Services inflation refuses to drop toward the Fed's 2% target. Demand keeps building. You can't starve a market when its biggest customers just got handed a raise that they didn't earn. A young household with a 7% mortgage cannot afford a Caribbean cruise. Meanwhile, a retired couple with $1.2 million in treasuries can take 4 cruises a year. They're the ones who set the price. Leisure economy prices respond to who can pay, not who used to pay. The pattern repeats itself across the market. Fitness brand SoulCycle's parent company is reporting record bookings for premium retreats and high-end fitness experiences. Meanwhile, Restoration Hardware has openly positioned itself around older, wealthier buyers, furnishing and upgrading homes with cash. Concierge medicine networks like One Medical and MD VIP have waiting lists for new patients. None of these businesses care where the federal funds rate sits because their customers don't need a loan to buy. And the spending spree isn't contained to vacations and dinner reservations. The same cash flow is quietly destroying the housing market for everyone under 40. Chapter 5. The Cash Buyer Cartel. According to the National Association of Realtors, in 2024, 31% of repeat home buyers purchased their homes entirely in cash. At the national level, ATTOM Data Solutions tracked the same shift. All cash sales reached 32.8% of total home transactions in the first half of 2025. That means nearly 1 in 3 American homebuyers is operating in a market where mortgage rates don't matter at all. In certain markets, the numbers turn surreal. West Palm Beach, Florida, closed 49% of all home sales in cash in 2025. Miami came in at 43% overall, climbing past 65% in the segment above $1 million. In Naples, Florida, iLocal Realtor data and Redfin tracking show cash buyers closed about 60% of all single-family transactions in 2024. The median sale price topped $800,000. Mortgage-dependent buyers in Naples are the people who actually live and work there year-round. They're now boxed out by retirees flying in from New York and Illinois with checks already written. Cash wins on every variable that matters to a seller. It offers speed, certainty, and a clean close with no bank dragging out the underwriting. A split market means 2 pools of buyers, 2 pricing structures, and 2 very different outcomes. High rates only punish borrowers. The 55 and over cohort sits largely outside of the rate environment. They're not financing purchases the same way, and they're often holding assets that benefit from higher yields. Fed policy isn't hurting them, it's paying them. You can't out-earn a cash buyer. You also can't afford the rates being used against you. So the next question stops being about strategy, it becomes about whether the path to ownership still exists for anyone born after 1985. Chapter 6. Root Cause: The Death of Labor. The U.S. wealth-to-GDP ratio is the most important number in American economics that almost nobody talks about. In 1985, it sat at around 3.6. By 2024, it was closer to 5.5 according to the Federal Reserve. The bottom number, what people earn from working, rose steadily like it always has. But the top number, what people already own, pulled away fast. That gap didn't widen because people worked harder. It widened because ownership compounds. The economy isn't just rewarding effort anymore. It's rewarding being early. Look at the income data from the U.S. Bureau of Economic Analysis. It tracks something called the labor share of national income. Basically, how much of every dollar earned in the economy goes to wages. In the early 1980s, that number was about 64%. Today, it sits closer to 56%. That difference didn't just disappear, it shifted from paychecks into asset returns. Every percentage point that moved out of wages and into capital is hundreds of billions a year. Returns flow to whoever already controls that pile of assets, not to anyone making new value. America hasn't quite reached the extremes of 19th century Britain's feudal system quite yet, but the trajectory on the wealth to GDP chart is pointing right at it. If labor is dead as a way to build wealth, only one path is left for people under 40. Chapter 7. The Inheritance Trap. According to LendingTree, 78% of Gen Z homeowners aged 18 to 29 got family help to make their down payment. 33% of them said outright that they could not have bought the home without it. The widely cited $84 trillion great wealth transfer is real. It's happening. Cerulli Associates projects the money will move from older to younger generations over the next 2 decades. But the transfer is conditional. It runs through the bank of mom and dad. The people without that bank are being pushed out of the ownership economy. Redfin's 2024 buyer survey said 36% of all Gen Z and millennial buyers received a cash gift from family to close the deal. 16% used inheritance money. The average gift size came in above $50,000. In high-cost metros like Boston and Seattle, gift sizes often run past $150,000. A permanent class of winners and losers is being created, one that's based entirely on birthright. Buyers without family help aren't just buying slower, they are falling off of the ownership ladder entirely. They turn into lifelong renters paying the mortgages of the gifted group through their lease checks. So what kind of society replaces work with waiting? An economy where the timing of a parent's funeral matters more than your day job. The answer is one that we already have. Most people are just starting to figure it out. Chapter 8. The Reckoning – The Demographic Wall. The Census Bureau projects U.S. population changes out 20 years in advance, and they have been consistently right. What it shows is that the generation born between 1946 and 1964 is aging on a fixed timeline. There's no ambiguity, just a known curve moving forward. Actuarial tables already price in when that wealth starts to unwind, not as a theory but as timing. The Federal Reserve has already run models on what that shift does to wealth distribution over time. This isn't something that you need to interpret or speculate about, it's already locked in. Tax reform cannot move $79 trillion fast enough to help anyone currently under 40. A return to zero rates would just reinflate the asset values that caused the gap to begin with. Voting majorities, even if you could assemble them, cannot undo 40 years of asset concentration, and the generation that benefits from the current setup votes at higher rates than anyone else. Only one way out exists, and it's a funeral. The wealth pile described in this report ends when its holders end. Inheritance from Chapter 7 then decides which descendants get the keys. No other off switch is on the table, only time and death can stop the cycle. A wealth tax, if Congress ever passed one, would face constitutional fights measured in decades. The estate tax already exists, but the threshold sits above $13 million per person in 2025. Most boomer estates pass tax-free under that ceiling. The fiscal levers Washington has on the table are too small for a $79 trillion problem. The tools that could actually move the needle require a political coalition that doesn't exist and cannot form. No corporation stole the American dream. No foreign power seized it. The generation that invented the post-war version of the dream bought it in cash. They picked up houses for 2 years of salary in 1972. They then watched those houses become retirement accounts worth 15 years of a young person's salary, and now they collect interest on the cash that funded the heist. The system is working, just not the way people assume. It's tracking the demographics underneath it. Inflation control isn't broken at the Federal Reserve. It's operating inside an economy where different age groups respond completely differently to rate changes. Same policy, different effects. Housing isn't malfunctioning either. It's being reshaped by who already owns assets versus who still has to borrow to get in. And over time, that difference compounds into a sorting mechanism, not by policy design, but by birth year. The outcome doesn't really look like a crisis. It looks like a system doing exactly what it's set up to do. It doesn't end all at once, it just plays out slowly as one generation leaves the system over time. Until then, wealth keeps drifting the same way it already has, more from owning things than from working for them. Effort doesn't disappear, it just stops being the main way money moves. You don't really get a choice to opt out. You just end up where you were born into it. You were told that a six-figure salary was the finish line, that you had made it. But for the majority of Americans earning $100,000 today, it just means that you're keeping your head above water. On paper, the economy is stronger than ever. In reality, the cost of living has climbed faster than paychecks ever could. To match the same middle-class life your parents could afford on a single income in 1985, you would now need about 62 weeks of work in a year. The middle class didn't disappear, it just started living on time it doesn't have. Chapter 1. The 62-Week Year. The American dream used to have a simple definition: work hard, earn enough, and you can afford a stable middle-class life. But the question is whether that definition still holds. Economist Oren Cass and his research group, American Compass, developed something called the Cost of Thriving Index to test exactly that. The idea is simple. Take one family and one basket of basics, and then ask how many weeks do they have to work to pay for the items. The basket covers groceries, a modest home at the 40th percentile, family health insurance, and a car for work. Then add in college for the kids on top of it all, and that's the base of an ordinary American life. In 1985, the answer was about 40 weeks. The average middle-class American paid for all of it and still had a fifth of the year left over. That leftover turned into savings, into a down payment, into a bit of breathing room for a bad year. By 2022, the same basket swallowed 62 weeks of pay. It now takes 14 months of work to buy 12 months of a normal life. The shortfall is not bad luck or a rough patch, it's baked into the system. There's a cruel twist buried in the wages. That 1985 worker earned about $443 a week. His 2022 replacement took home about $1,200, nearly triple the paycheck. On paper, he looks 3 times richer, but the cost of basics rose faster than the raise ever could. The bigger number now buys a smaller life. A single income used to carry a household. Now it takes 2 paychecks to barely buy what one used to. The American middle-class family added a whole second earner and stayed in the same place. So when a household looks fine, something is usually holding it up behind the scenes. It might be a second job, or overtime, or gig work after the kids are asleep, or a credit card filling in the gap. None of that is a choice anymore. It is how people survive. You might think this only affects a small number of families. It doesn't. In early 2024, the research group Payments found that 48% of households earning over $100,000 a year live paycheck to paycheck. It doesn't stop there. Roughly 36% of households earning over $200,000 report the same thing. These families are known as Henrys, high earners, not rich yet. They hold the salary their grandparents would have called a fortune. Behind it sits drained savings and a retirement fund that keeps sliding away. They do everything their parents did. They follow every rule they're told, and they're still losing ground. So if the people at the very top are going under, who is this booming economy actually booming for? Chapter 2. The GDP Ghost. The booming part is not exactly a lie. The economy grew around 2% in 2025. Unemployment stayed low for a long stretch, and the S&P 500 kept hitting record highs. By those readings, everything looks healthy. The trouble is what's left out. Think about what actually matters. GDP tracks output, the total dollars of goods and services produced. It tells you how big the economy is, not how far your paycheck goes. Unemployment tracks whether you have a job, not whether that job lets you afford rent, food, or basic stability. Both are useful indicators, but neither answers the question that people actually live with. Does working full-time still cover a normal life? A lot of what we call growth is just the staggering cost of standing still. A lot of the jobs being created sit in the service economy. Walmart, the largest private employer in the country, employs roughly 1.6 million Americans, but the wages in those roles don't keep pace with rent or health insurance costs. Since the late 1970s, a typical worker's pay has risen about 14.8%. The output from each worker has risen about 64.6%. CEO pay over that same stretch jumped over 1,300%. There's a huge disparity between those doing the work and those reaping the rewards. Economists sometimes describe the pattern after downturns as a K-shaped recovery. One line rises for those who own the assets. The other drifts lower for those who rely on wages. The same economy, 2 very different trajectories. So the economy keeps growing while the family budget shrinks. People feel the gap even when they can't name it. For years, they have told pollsters the economy feels rough, and the data keeps insisting they're wrong. Writer Kyla Scanlon calls this gap a vibecession. It's the distance between how the economy looks on paper and how it feels at the kitchen table. Surveys from the University of Michigan have tracked that mood staying weak for years, even as major economic indicators continue to rise. That disconnect isn't random. It reflects what those indicators measure and what they don't. GDP and unemployment are useful tools, but they don't capture the cost of holding a normal life together. Rent, healthcare, groceries, and everything it takes to stay stable month to month. So the numbers move on charts and headlines, but they don't always match what people are actually feeling. Chapter 3. The Big Four. You've been told you're richer than your parents because your things are better and less expensive. The television is huge. The phone in your pocket could outperform a 1985 supercomputer. Economists even adjust inflation figures for quality changes in products. It's called hedonic adjustment because a phone or a TV today is better than one from 10 years ago. But in real life, that improvement doesn't always translate to feeling better off. You might be able to afford a large 4K television. What's harder is affording the space to live comfortably around it. Because the biggest shift hasn't been in gadgets, it's in housing. A home used to cost about 3 times a household's annual income. In many cities today, it's well over 5. Take Austin as an example. The price-to-income ratio reached about 5.75 in 2022. By mid-2025, it had cooled to around 4.31, but that is still above its long-term average of roughly 3.9. And the barrier isn't just monthly payments. A 20% down payment on a median home can mean around $80,000 up front. That's money most renters can't save while covering rent and daily expenses. After the 2008 crash, the Wall Street firm Blackstone moved quickly to buy up foreclosed homes at scale. It later built a company called Invitation Homes, which at its peak managed roughly 80,000 properties. Another major player, Progress Residential, grew to around 97,000 homes. In Atlanta, big investors at one point owned close to 25% of all single-family rentals. The starter home stopped being a place to live, and it became a return on someone else's money. Childcare is another drain on the middle class. The federal government calls childcare affordable at 7% of your income, a bar almost nobody clears. The average cost runs over $13,000 a year for a single child. For 2 kids, you are past $26,000, more than many Americans earn before taxes. In an expensive metro, 2 children in care can eat 30 to 40% of a $100,000 salary. In 45 states, it now costs more than the average mortgage. In 38, it runs higher than in-state college tuition. Then there's the problem of healthcare. In 2024, the average family plan was close to $25,600. By 2025, it was $27,000. Employees cover roughly $6,300 of that straight out of their paycheck. Over 5 years, those premiums jumped 24% while wages lagged behind. Most of the country can't get to work without a car either. By 2025, a new car payment cost around $750 a month. The insurance alone topped $2,000 a year before a drop of gas hit the tank. The system doesn't feel like it's breaking, it already has. Chapter 4. The Debt Illusion. America's middle class is living on borrowed money. By late 2025, credit card balances hit a record $1.28 trillion. Add on about $1.66 trillion in auto loans and another $1.65 trillion in student loans, and household debt reached $18.59 trillion, another all-time high. The mortgage sits on top of all of it. The strain is starting to show in places it shouldn't. In 2025, more people in their 60s and 70s fell behind on their credit cards. It was the worst rate seen since 2001. A warning sign. The people who were supposed to be safe are being caught in the economic trap. The detail that matters the most, though, is what the borrowing really buys. Roughly 60% of cardholders now carry a balance month to month. In one recent survey, 55% said the balance exists to cover essentials: the groceries, the gas, the stretch between the paycheck and the rent. When most credit card debt is used to cover basic necessities, it stops being a story about overspending. It becomes a signal of something deeper, a gap that no ordinary income was designed to close. The debt isn't sitting on top of savings, it has taken its place. After that, the interest goes to work on whatever's left. At a rate near 20%, a $5,000 balance can cost $1,000 a year just to carry. That is money that buys nothing but time. That's why one bad moment can tip the whole thing over. A medical bill, a sudden layoff, a car breakdown. The line between a stable family and a missed payment has blurred. Chapter 5. The Doom Loop Algorithm. For a long time, people judged the economy locally by their job, their numbers, the street they lived on. Now it comes from social media feeds, where posts are ranked by algorithms. Those feeds have an agenda. They don't show everything equally. They prioritize what keeps people scrolling, and uncertainty tends to hold attention, so the algorithms push the scariest posts to the top. One day, it's layoffs at Meta and rounds of cuts at Google. The next, it's someone crying in a parked car after Amazon let them go. One bad week at one company starts to feel like proof of something bigger. It's known as money dysmorphia. It's the gap between how well you are doing and how broke you feel. It widens every time you scroll. Fake wealth sits on one side of the screen, doom on the other. Almost nothing in between tells you what normal even looks like anymore. This design is deliberate. A clip of a $400 grocery run pulls in millions of viewers. The story about a steady job pulls in none. The system shows you the panic and the fear and buries the ordinary and the mundane. You start to believe that everyone is broke and you are next in line. It's easy to dismiss all of this as a phone problem. But that misses what's actually happening. This isn't just about distraction, it's about how the information about the economy is now filtered and amplified at scale. Public perception of the economy often doesn't match individual financial reality. People can feel better or worse about conditions without their own income or bills changing. You can see it most clearly after elections. The same set of economic conditions is interpreted very differently depending on who's in office. The underlying numbers haven't shifted overnight, but the way they're talked about and felt often does. And even worse, it's a feedback loop. Confidence is not just a reading of the economy, it shapes the economy. When enough people brace for a crash, they stop spending, they delay their purchases, and they hoard what they have. The slowdown they feared starts to come true. The genuine cost pressure feeds the fear, and the fear feeds the content. The content blows it up larger, and at every turn the platform takes its cut. The feed determines your mood, sells it, and then hands it back to you as news. And it all traces back to one place. Chapter 6: The Financialization of Survival. The things people need to live have increasingly been turned into assets that generate returns for someone else. Housing is the clearest example. It's no longer just shelter, it's also an investment that only works if prices keep rising. And rising prices means it becomes harder for the next person to afford it. Wall Street firms and big pension funds pour money into the housing market to fund someone's retirement. But it's not yours. College took the same path. Loan servicers like Sallie Mae and Navient collected on student debt for years. Schools get paid up front while the student pays it into middle age. Even the private equity money kept hunting for more, buying up apartment buildings, mobile home parks, and hospitals. Every aspect of our lives is being squeezed for profit. Bright Horizons runs childcare as a publicly traded business under the ticker BFAM. United Health, the largest health insurer in the United States, generates some of the highest profits in the entire healthcare sector. What used to be a nursery and a doctor's office now operates at scale as part of the revenue side of the economy. Workers keep producing more each year. The reward for that lands with whoever owns the assets, not with whoever does the work. The richest 10% of Americans own most of the stock market, while the bottom half owns almost none. When asset prices soar, most people are watching from the outside. None of this is a glitch. The machine is doing exactly the thing it was built to do. It moves wealth from labor to assets year after year. The workers kept busy and paid just enough to keep going. It's here to stay. The Vibe session is now a perma session, and the American dream is hanging by a thread. Chapter 7: The End of Progress. The American dream had a clear path. Each generation was supposed to stand a little higher than the last. A home would hold wealth that outlived you. Your children would start with more than you ever had. For the typical worker, that path is gone. The goal is no longer to get ahead, only to not fall further behind. Holding your position has become the whole ambition. The young generations inherit the worst of the deal. They have heavier debt, while milestones are pushed back. Their birth rates keep sliding toward record lows, and the reason is not some loss of desire for children. People are being priced out of having them. The typical first-time homebuyer is now 40 years old, a record high. In the 1980s, they were in their late 20s. First-timers have shrunk to just 21% of the market, the smallest share ever recorded, and many never buy at all. More and more, the home you end up with depends on the money you inherit, not on the job you work. Some escape to cheaper towns far from the workplace, but the trade is distance and the people they leave behind. The wealth gap by age tells the same story from the other end. Older owners hold homes that double or triple in value. Younger workers hold rent receipts and loan statements. America gave its old and its young two completely different economies. The deficit, meanwhile, refuses to sit still. The same forces that dragged an ordinary life from 40 weeks of work to 62 are still running, and it will keep climbing. There's nothing to slow it down. The economy will continue to grow. Officials will point to the strong numbers on camera, and those numbers will all be accurate, but they won't capture what people are experiencing in their daily lives, because for many households, higher incomes haven't translated into feeling ahead, only into keeping up with rising costs that move just as fast. The real question isn't about growth. It's about why a full-time year of work no longer feels like enough to cover a full-time life. A huge share of housing and wealth in the US is still concentrated into one generation that built it under very different economic conditions. When those assets begin to transfer, who actually benefits? You think you're broke because you aren't working hard enough. You're wrong. In 1980, the median U.S. home price was roughly 3.5 times the median household income. Today, in major hubs like New York and San Francisco, that has ballooned to over 10 times. The American dream has moved from a reachable hurdle to the height of a 40-story skyscraper. You're producing more value than any generation in history, but the math in today's economy makes it physically impossible to win. The system isn't failing, it's working exactly as designed. When it comes to wages and workload, most people ask two questions: why are we working more, and why are we being paid less? But the question that matters the most is the one nobody's asking: why isn't the money we're earning going as far anymore? And that's where we need to reckon with our first brutal reality. Inflation has stacked the affordability cards against us. Take housing, where in Q1 of 1980, the median home price for an American was $63,700, compared to Q1 of 2026, where it's an eye-watering $403,000. The same honest job and clever investment that could have bought you a house in the 1980s can barely cover rent today. But it gets worse. As of April 2026, the Consumer Price Index, or CPI, the metric that tracks the prices of consumer goods, showed that inflation rates were overshooting expectations. As Heather Long, the chief economist at Navy Federal Credit Union, put it, Americans are literally getting squeezed now. Gas prices at this same time were also costing $75 extra per consumer per month, which seriously eats into anyone's wallet. You're probably thinking, well, an increase in the cost of goods and services over time is only natural. But why do you think that? Track notable price spikes throughout U.S. history and you'll see that there are times when costs have been elevated way above the norm. The Revolutionary War, the Civil War, and World War II. The strange thing is, after the first two, the prices slowly fell back down to a reasonable baseline. After World War II, the cost of living kept on going up. Why? Well, figuring out the answer to this mystery is the key to knowing why you're overworked and underpaid today. Thomas Stableford is a historian at the University of Notre Dame and the author of The Cost of Living in America, a political history of economic statistics. According to him, it all leads back to policies set by the Federal Reserve. They believe that gradually increasing inflation is actually healthy for an economy like the United States, which invests so heavily in new technology and productivity. And the most concrete way to achieve this end is by minting new cash and putting it into circulation. In economic circles, this is called increasing the money supply. Now, this isn't a video telling you that your life is harder because the Fed made a bad decision 80 years ago for no good reason. Like with anything economic, we're dealing with an explosive rigged to colored wires that we need to cut if we want to financially survive. And unless you can see the future, you're essentially colorblind. One of the most concrete reasons for ramping up the money supply after World War II was to avoid a deflationary spiral. If you know anything about macroeconomics, these are two of the scariest words in the English language. A deflationary spiral was the key driver behind the start of the Great Depression, one of the most dire economic situations in American history. This is how it works. In the middle of an economic crisis like a recession or a depression, people have less disposable income to buy anything but the essentials. A reduction in demand in proportion to the supply of consumer goods leads to the price dropping. This in turn leads to production needing to downscale to reduce the supply and level out the costs. But this scaling back also means that companies don't need as many employees, so they let people go. Fewer people can afford to spend, while warehouses will fill with products that nobody can afford to buy. Prices and production both plummet in a terrifying race to the bottom, and that's what the Fed wanted to avoid. But every solution creates new problems. One of them is Baumol's cost disease, a mathematical flaw baked into the modern economy. It's been one of the huge hidden drivers for why you're overworked and underpaid. The central idea behind intentional inflation is that prices will rise, but so will wages as a result of increased technology efficiency in the workplace, so everything evens out. But not all the time. In labor-intensive sectors, we reach an efficiency plateau where you can't use technological advancement to increase economic efficiency. Take a singer, for example. Auto-tune and post-production mastering technology aside, there's no real way to make singing a more efficient process than it is. It's a dead end, compared to, say, mass-market car manufacturing or synthesizing new compounds in the chemical industry. A singer singing a song a century ago isn't any more productive than a singer singing a song today. This is true across the arts as well as in industries like education and healthcare, as sectors that rely extremely heavily on human labor. Meanwhile, technological advances make manufacturing more cost-efficient all the time, which increases wages there and in turn decreases or stabilizes the price. This is where the cost disease comes in. Costs in these low-productivity sectors still need to increase in order to keep pace with the rising wages across the rest of the economy. It's the consumers who bear the weight of that. This can have brutal knock-on effects like slowing economic growth overall and leading to rising costs for essential services. This begins to really explain the structural rot behind why your hard-earned dollars don't seem to stretch nearly as far as they used to. But that's only one part of the problem. And it might just be the perfect distraction while the job market pulls the rug out from underneath you. The job market is working against you. It's almost impossible to be a worker in the 2020s and not feel it. The effort you're putting in no longer seems to match the value you're getting back. But that value is going somewhere. To understand what's happening, we need to look at the labor share of income. It measures where the wealth generated by workers actually ends up, in workers' paychecks or in the hands of the owners and the shareholders. Some concerning studies have shown that the answer actually seems to be less and less to the workers. One actually identified 4 key factors that have played a role in taking the labor share away from workers and giving it back to the owners of capital. The first is technological advancement. They found that when the share of revenues spent on research and development goes up by 1 percentage point, labor share falls by up to 1.3 percentage points. The threat of being able to replace your workers with a machine decreases their bargaining power and keeps them content with low wages. The second is globalization, where a 1% increase in the share of revenue coming from exports leads to a 0.3% drop in labor share. Again, it gives the owners greater leverage over their employees. They have got freedom to relocate if they believe their workers are asking for too much of the share. The third is high market concentration, where competition is low and the share is divided between a relatively small number of companies. In these cases, companies have the leverage to keep their workforces lean and set their terms. In countries with strong union presence, like Sweden, this can turn to the workers' favor, but in the US it almost always shakes out in favor of the capital holders. The fourth is intangible factors like copyrights, patents, and trademarks that keep the reins in the hands of the capital holders. That's especially true when it comes to the right to research and development. Again, it's all about bargaining power, and the more value that the shareholders can consolidate at the top of the pyramid, the more labor value they can extract from you without consequence. The pie keeps getting bigger thanks to technology advancing and your hard work, but every time the pie grows, corporate interests readjust the knife to just give you a smaller slice. The quality of jobs are declining and the numbers of jobs needed to survive increases. Meanwhile, the economy keeps producing more wealth than ever before. You are just getting less of it. Even if you're no stranger to the modern workforce, 2 words you might not be familiar with in this context are internal mobility. This means your ability to actually progress at your workplace. That can be a lateral move, gaining the skills to take on a job in an entirely different department, or a vertical move, where your skills and experience can pay off in tangible advancement up the hierarchy of your company. That is the American dream, isn't it? That anyone could join a company at an entry-level position and through sheer grind and dedication one day find themselves on the company's board. But these days, it seems more and more like the promise of internal mobility in most jobs holds about as much water as a real Christmas Eve visit from Santa Claus. Part of this is a phenomenon in corporate America that some people are calling the Great Flattening. It's where the middle management class is downsized in order to streamline a company and increase operational efficiency. From tech giants like Amazon, Microsoft, and Google to huge retailers like Walmart and Starbucks, it seems like flattening the corporate structure is the order of the day. But you don't see the savings. In fact, it seems like it might be stacking the cards against you even further. Not only will you lose a lot of the guidance and morale that middle managers provide, you also lose the middle management promotion track. It's like they've detonated a bridge between 2 sides of a long river with labor on one side and capital on the other. The lack of internal mobility in a world of ever-rising costs has driven literally millions of people into working multiple jobs just to make ends meet. The data backs that up. According to the U.S. Bureau of Labor Statistics, 9.3 million Americans reported working multiple jobs in November of 2025. It made for 5.7% of the total active labor force at the time. And this isn't just a full-time job and a part-time job or even two part-time jobs. For 500,000 of those Americans, 2 full-time jobs have been fully accepted as standard operating procedure to anything above treading water in life. The burnout is real. This is particularly bad for workers in Gen Z who've entered the labor force in a world of technology-induced economic uncertainty. Fewer people than ever are employees with true salaries and all the attendant benefits. Instead, people are becoming part or full-time contractors for different companies. The expression for this is income stacking, and it feels like a far cry from the world of the 20th century where one income was often enough to get by on. But even if you're not working multiple jobs, there's a good chance you still probably feel drained at the end of the week. What makes work so insanely exhausting that it feels like our lives are losing space and energy for anything but more work? Turns out that it's not just you losing your stamina. It's the result of a concentrated workplace strategy that is grinding you away to nothing. A corporate buzzword you probably hear a lot is efficiency. It's one of those words that helps shareholders sleep comfortably at night. But like anything that delivers a quick dopamine hit, it comes with real costs if you reach for it without thinking. One of the most dangerous and short-sighted corporate decisions made in service of so-called efficiency is lean staffing. And it's one of the main reasons you feel like you're always overworked. This tactic is exactly what it sounds like, running your company with the absolute bare minimum of staffers possible for it to work. This results in employees pulling double duty and wearing many different hats. In the past, lean staffing has been an emergency measure in times of dire financial straits at a company, but some of the management class have figured out that it will lead to even higher profits to run lean when the revenue stream is solid. This, by the way, is kind of like taking morphine when you're perfectly fine, just in case you break your leg later. It might feel pretty good in the short term, but in the long term, you're on a collision course with real trouble. And that is just for the owners and shareholders. For you, the ground-level worker, the awful side of lean staffing will be apparent a lot quicker. There's a reason why another name for this kind of corporate structure is just-in-time staffing. Hourly workers, who make up around 55.8% of workers in the U.S., need to break their backs responding to the immediate needs of their employers. The result of these corporate structures for workers is generally horrific fatigue. They work long hours with huge numbers of complex tasks in a high-pressure work environment. It probably won't surprise you to hear that absenteeism tends to spike in lean staffing situations. Workers frequently get physically sick from the exhaustion of overwork. And the science is in. If you are overworked, it's gonna make you sick. And if you keep doing it for too long, it is going to kill you. The BBC reported in 2021 that people working more than 54 hours a week are at a major risk of dying from overwork. It happens to almost 1 million people every year. Overwork is, in fact, the single largest driver for occupational disease, thanks to the genuinely ruinous effects that stress can have on the human body. Bosses are enjoying the image of paying out fewer salaries on their balance sheets. Meanwhile, you will be doing twice as much work as before with tight turnarounds that don't allow for any slack. Speaking of slack, the increasing role that technology plays in moderating the workforce is another factor that makes you feel so overworked all the time. Before the advent of computers, you would clock in at 9 and go home at 5 at most jobs. Now, thanks to Zoom and Slack, your boss can wait around in your pocket or in your living room. It destroys the traditional separation that makes work-life balance, well, a balance. Especially for the digital nomads of the world, you are never on, but also you're never really off either. But it gets even more intrusive. The cottage industry of employee monitoring software, also known as bossware, has increased your standard level of workspace even more. It puts you in a kind of work panopticon. You feel the need to always be on your best behavior in case a live feed of your screen is being watched or every keystroke is being logged and fed straight to HR. This is even worse in a flattened, lean staffing setup where your boss might genuinely have the free time to actually sit in and watch what you're doing all day. You might think that maybe, even though it's killing you, you just need to work a little bit harder to push through the barrier. But that might be working against you too. You probably heard the old phrase, no good deed goes unpunished, and in the corporate world there is plenty of evidence that this is actually empirically true. Welcome to the world of performance punishment, where hard work earmarks you as exploitable rather than employable. If you got a great track record for quality work and hitting deadlines, there's a good chance you'll find more work being delegated your way, but not with any greater compensation for the overtime. Maybe it's because you genuinely are an exceptional employee. Or maybe it's your coworkers intentionally getting more loaded onto your plate with weaponized incompetence. In either case, the result is the same. You're getting punished with extra overwork for the crime of actually doing your job well. You might think that maybe good work like this will make you a shoo-in for a career advancement, and that is rarely the case. Most companies won't want to start paying you extra for the hard work you're already doing out of the goodness of their heart, because they don't have hearts to appeal to. Advancing into a different department for your hard work would also be counterintuitive to their purposes too, because who would fill in your shoes? Sometimes doing your job too well will be the ultimate tip-off to your employers that you should just keep that job for as long as you can physically stand it. And when you eventually leave, either due to frustration or health problems, then they'll consider who else they should get to fill in your broken shoes. You'll be little more than a memory. You'll be lucky if you get more than a thank you and the standard severance package for the time, energy, and health you poured into all this. The economy isn't what it used to be. Thanks to the fundamental oversights in the financial systems of the United States, costs will continue to climb while wages will continue to stagnate. The labor share of value will continue to tip more of the wealth you create into the pockets of your bosses, who are laying off middle managers and running skeleton crews while posting ads for jobs that don't exist on listing sites. You're frozen in place, working yourself to the bone at one or more jobs where technology erodes the boundaries between work and life. All the while, performance punishment ensures that any attempt to work yourself out with hard work just digs you deeper into the hole. You're overworked and underpaid because that's how you're most useful to the system. And until the system itself changes, that is not going to change for you either. So if you're overworked, underpaid, and still falling behind, the system should be breaking, but it's not. Hey, it's Josh, and today on the Infographic Show, we're asking what would happen if everyone tried to pull their money out of the bank tomorrow. On a normal day, banks look boring. People swipe their cards, they pay their bills, get direct deposits, and maybe stop by a branch to grab a little cash. But behind the scenes, it's a lot different. Your bank is moving money digitally between accounts, approving loans, and investing deposits to earn a return. Here's the important part most people don't realize. Your money isn't just sitting in a vault. Banks only keep a small fraction of deposits as physical cash. The rest is loaned out for mortgages, car payments, business investments, and government bonds. That system works because on a regular day, only a tiny number of people want their money at once. So basically, at a bank, everything runs on trust. Trust that your paycheck clears. Trust that the ATM works. Trust that when you need your money, it'll be there. But all it takes is one headline, one rumor, or one unexpected shock to flip that trust upside down. And when that happens, the calm, the everyday routine, collides with something much more dangerous. Something that could lead to some people losing everything. A bank run doesn't start with chaos, it starts with something small going wrong behind the scenes. As long as customers believe their money is safe, daily life continues as normal. But when that confidence takes an even small hit, unease begins to spread. And that trigger could be almost anything. It could start with a sudden stock market crash and reports of mounting bank losses, or with rising interest rates that erode the value of long-term investments. A major business customer might pull out a massive deposit, or an earnings report could reveal a bank struggling to balance what it owes depositors against money tied up in loans and bonds. And that is when the clock starts ticking. Remember, banks don't keep most of your money as cash. They lend it out or invest it, so if the value of those assets falls, or too many deposits leave at once, the bank's cushion begins to shrink. On paper, the bank still holds its assets and maintains its balance sheet, but it has far less room for error. In some situations, the problem is simply speed. A modern bank can lose billions of dollars in a matter of hours, especially when large corporate clients move money digitally and without warning. If a bank can't sell investments quickly enough without taking major losses, its financial position weakens. Nothing has exploded yet, and there's still a chance that the bank could meet its obligations. ATMs still work, transfers still go through, but behind the scenes, regulators, executives, and investors are watching very closely. And what happens next will determine whether the bank survives or collapses entirely. And out in the real world, customers might begin to sense something's off. There's no full-blown panic yet, just discomfort. A feeling that the system isn't as solid as it looked yesterday. That unease is the spark. And what happens next causes that spark to turn into an inferno. This is the moment everything changes. Up until now, people just felt uneasy. But once a bank actually looks like it might be in trouble, fear takes over. Customers stop asking questions and start taking action. They log into apps, they visit branches, and they hit ATMs, not because they need the cash, but because they don't want to be the last person left when the money runs out. Banks are built for normal days. Maybe they can handle slightly busy days, but they're not built for stampedes. Every institution carefully plans how much cash it needs for daily withdrawals. The Treasury system works when behavior is predictable. But when more people than expected start pulling their money out, those reserves start to get strained fast. The further withdrawals go beyond what the bank planned for, the higher the risk becomes, and customers can sense that. A few missing features in an app, a slower wire transfer, a longer line at the branch. Each small delay feels like proof that something is wrong. And here is where things start to spiral. A bank run happens when large numbers of people withdraw their money from a financial institution in a short period of time. As withdrawals grow, the bank starts to look weaker to everyone who still has money there. And as the bank looks weaker, even more people rush to pull their funds. Fear feeds fear. One person's just in case becomes another person's emergency. The situation snowballs until the bank simply can't keep up. Too many people want cash at once, and the money just isn't liquid enough to move that fast. The money locked up in mortgages, business loans, and government bonds takes too long to convert to cash. So to meet demand, banks are forced to sell assets as quickly as possible. And selling fast means selling cheap. Loans get abruptly called in. Bonds are dumped at rock-bottom prices. Every rushed sale weakens the bank even more, making customers even more nervous. History shows how violent that feedback loop can become. During the Great Depression, the stock market crash made people doubt the financial system. Depositors rushed to pull out money, forcing banks to liquidate assets just to survive. News of one bank run triggered another and another and another. The panic spread faster than any regulation could contain. In 1930, one rumor alone helped sink the Bank of the United States. After a customer walked out angry and spread talk of insolvency, crowds formed within hours. By the end of the day, millions in cash were gone, not because the bank failed first, but because fear did the damage before the truth could catch up. But modern banking moves even faster. In 2023, Silicon Valley Bank saw about $42 billion leave in a single day as corporate customers transferred money digitally. No lines, no shouting, just a few simple clicks. The withdrawals overwhelmed the bank's ability to sell assets or raise capital fast enough to pay out its customers. And to customers, that feels terrifying. If you're told that you can't get your money, your first thought isn't relief, it's, what are they hiding? And that thought pours gasoline on the fire. At this stage, the run is no longer controlled. Every withdrawal makes the next one more urgent. Every headline brings more customers demanding their money. And the worst part, this is only the beginning. Once panic hits the banks, the damage doesn't stay inside the walls. It starts to spill out into the entire economy. That's when mitigation measures kick in. Emergency tactics designed to slow the run, restore confidence, and keep the institution from failing outright are launched. Some of these moves are subtle, others are dramatic, and all of them are about buying time. First, the banks try to slow everything down. In the past, banks literally slowed people in line. During U.S. recessions, employees and even their relatives would stand in front of tellers making tiny deposits and withdrawals just to clog up the system and delay the rush until closing time. Today, the same idea exists digitally. Transfers suddenly take longer, apps show technical issues, wires get delayed, limits are placed on how much you can move in a day. None of this fixes the problem, it just slows the bleeding long enough for the bank to react. And then they start scrambling for cash. If reserves aren't enough, the bank borrows from other banks and money markets or directly from the central bank. This is why the central banks are called the lender of last resort. Their job is to inject cash into the system when panic threatens to wipe out otherwise functional institutions. In 2023, the U.S. Federal Reserve created the Bank Term Funding Program, allowing banks to borrow against their assets to meet withdrawals, assuming those investments would eventually mature at full value. Programs like this are designed to quickly turn frozen assets into usable cash. If a bank can borrow a massive amount of cash fast enough, it may be able to stop a run before it becomes fatal. But borrowing also carries risk. It keeps the lights on today while pushing the problems into tomorrow. Then comes the reassurance. One of the strongest anti-panic tools is insurance on deposits. In the U.S., the Federal Deposit Insurance Corporation, or FDIC, was created after the Great Depression to guarantee customer money up to a limit if a bank collapses. If people believe their deposits are protected, they're less likely to sprint for the exits. And if a bank actually fails, the insurer steps in. Sometimes another strong bank will buy the troubled one and customers barely even notice the switch. Other times, regulators seize the bank and sell off assets to pay depositors back. Deposit insurance doesn't create new money, but it does redistribute losses across the system. Banks may also try to lock money in place. Another tactic is encouraging term deposits. These are accounts that pay higher interest but can't be withdrawn until a set date. By locking up part of their liabilities, banks protect themselves from sudden cash demands. If enough money is tied into non-callable deposits, the bank can survive even while other customers withdraw. But here is the unfortunate truth. Mitigation doesn't always lead to a solution. Slowing transactions, borrowing cash, and guaranteeing deposits can stabilize a bank temporarily, but they can't undo the losses already locked into bad assets or panicked withdrawals. Eventually, the moment everyone fears arrives. At the start of a run, cash flows out fast, but after hours, sometimes even minutes, the vaults, ATMs, and digital settlement systems start to hit hard limits. People try to withdraw their money and suddenly the machines say no. There's simply no more liquid cash available to release. The hard truth is that even if the bank has assets it could sell, there's simply not enough time to convert them into cash and get it to customers' accounts. Panic drives the vast majority of people to demand their money at once, and the bank just can't keep up. But there's an even more terrifying scenario. The bank might have sold all its assets, many of them at a loss, and that means that there's literally no money left. In this case, the only way people will get their money back is if someone else, like the government or another financial institution, steps in. At this point, the bank isn't choosing to stop paying people, it is physically unable to meet the demand. The money is either trapped in future sales or loans, while customers need it to be in the present. Once liquidity is gone, the crisis stops being about fear and starts to be about math. There simply isn't enough cash to satisfy everyone asking for it all at once. And when a bank can't pay its customers, the problem quickly spreads. One institution's failure sends shocks through the entire system. When a bank finally runs out of options, the crisis stops being private and becomes public. If a bank can't meet withdrawals, it effectively fails. At that point, the Federal Reserve, regulators, and government institutions have no choice but to step in. Not to save a single bank, but to protect the entire system from collapsing with it. Historically, this is where the government takes control. During the Great Depression, after Franklin D. Roosevelt became president in 1933, he declared a nationwide bank holiday. Every bank in the country closed temporarily, so federal inspectors could check which ones were strong enough to reopen. Weak banks were reorganized, merged, or shut down completely. Roosevelt also understood that money runs on psychology as much as math, so he went straight to the public. In radio broadcasts, he told the Americans that keeping money in a bank was safer than hiding it under a mattress. He promised that reopened banks would safeguard deposits and that the government would not allow endless failures to continue. Those words mattered. They helped slow the bleeding by restoring confidence in institutions that people had completely lost faith in. But speeches weren't enough. When a modern bank collapses, the FDIC usually moves in behind the scenes. It may seize the bank after business hours, arrange a takeover by a stronger institution, and reopen the next business day under new ownership. To customers, it can look like nothing happened, even though the original bank technically died overnight. At the same time, the Federal Reserve injects liquidity into the system. It lends to healthy banks, stabilizes payment networks, and tries to make sure cash keeps moving so one failure doesn't trigger 10 more. But here is the reality. When the Fed steps in, it means the bank that held people's hard-earned cash has completely failed. After the panic, the freezes, and the government takeover, one question matters more than anything else to the regular people. Do I get my money back? When a bank run occurs and it leads to the bank failing, recovery doesn't mean everything magically returns to normal. It means sorting out who gets paid, how much they get, and who ends up taking the loss. In the United States, the most important safety net is deposit insurance, and through the FDIC, customer deposits are guaranteed up to $250,000 per depositor, per bank, per account category. That means if your bank collapses, the insured portion of your money is protected. In many cases, the process is fast. Regulators arrange for another bank to take over the failed one, and customers regain access to their insured funds almost immediately, or at least by the next business day. Checking accounts will reopen, debit cards work again, direct deposits resume, and so for millions of everyday customers, recovery feels almost instantaneous. Their money survives because it was insured. But not everyone is that lucky. Any amount above the insured limit is not guaranteed. If you had $300,000 in one account, only $250,000 is protected. The remaining $50,000 becomes a part of the failed bank's assets. You might get some of it back later after loans and property are sold, or you might get almost nothing. It depends on how bad the collapse really was. Large businesses, investors, and wealthy depositors feel the pain first. Payroll accounts, operating cash, and corporate reserves can be frozen or partially wiped out. And that's how a bank failure can ripple into layoffs, missed paychecks, or bankrupt companies even after the bank itself is gone. Recovery also takes some time. Assets have to be sold, debts have to be settled, Legal processes grind forward. While insured customers move on, uninsured depositors can wait months or even years to learn how much they'll recover, if anything. So while the system protects the average person, it doesn't protect everyone equally. Bank runs don't just destroy banks. They can have lasting effects on people, businesses, and the economy. Some people walk away almost untouched. Others lose savings they spent a lifetime building. Your grocery bill isn't skyrocketing because of corporate greed or government spending. What if the real reason costs keep rising is thousands of miles away? A patch of the Pacific Ocean has just hit record temperatures, helping devastate cocoa and coffee harvests around the world. Farmers are facing financial collapse, and your morning coffee has become a geopolitical casualty. The hidden tax you're paying isn't going to the government, it's being swallowed up by the Pacific Ocean. Chapter 1. The $12 Chocolate Bar. The last El Niño in 2023 and 24 caused unprecedented havoc in global agriculture, including major disruptions to the supply of cocoa, coffee beans, and even water. Cocoa futures surged over 150% between June 2023 and late 2024, peaking at almost $12,200 per imperial ton. That's like the price of silver increasing fivefold in a single year. That El Niño was considered strong. It was one of the main factors in 2024 being the hottest year on record. And that was literally the warm-up. This time, the National Oceanic and Atmospheric Administration, or NOAA, is anticipating a super El Niño, the strongest one in 150 years. To make matters worse, it's expected to be in the summer of 2026 and then last through to February 2027. The 2023-24 El Niño caused widespread droughts, floods, and wildfires. It severely impacted agriculture, leading to export bans and shortages of critical crops like rice. It caused shipping delays and power shortages due to low water levels. The combination of these factors caused food prices to soar globally. That was a strong El Niño. Now imagine the havoc a super El Niño is gonna wreak. It's a phenomenon that's becoming more frequent and more powerful. Some scientists are waving the red flag that we may already be in a state of more or less permanent El Niño. The price of key crops is expected to increase sharply because the effects can last up to 3 years after the event. Cocoa prices have fallen 70% since the record El Niño spike of 2024, but the price of chocolate hasn't, not even close. If it wasn't for the action taken by manufacturers, it probably would be much more expensive than it already is. In an attempt to keep prices under control, confectionery makers have been compelled to introduce shrinkflation, smaller chocolate bars for the same price. The latest casualty is the standard Mars bar, which shrunk from 1.8 ounces to 1.41 ounces in April 2026. Companies like Lindt and Sprüngli, Mondelez, and ingredient supplier Barry Callebaut have also resorted to skimpflation. They're substituting cocoa butter with shea butter and palm oil. Others are using yeast extract or cocoa alternatives made from roasted grape and sunflower seeds. So, El Niño has already caused chocolate bars to become smaller, less chocolatey, and more expensive. Now cocoa prices are about to start rising sharply again. There's no way around it. Your finances are at the mercy of El Niño. Climate change is real and you can feel it directly at the checkout, but the impacts don't just affect crops. Chapter 2. The Panama Choke Point. El Niño also caused droughts that led to lower water levels along the vital shipping routes. The writing was already on the wall during the 2023-24 El Niño, particularly in the Panama Canal. The 51-mile canal is the single most critical choke point for the United States agricultural trade. Some 14 to 17% of all U.S. agricultural exports by volume transit the canal. More important to your grocery bill, though, roughly 40% of all U.S. container traffic passes through the canal. That includes huge quantities of inbound fruits, vegetables, raw ingredients like cocoa, and processed food. Disruptions in the canal cause ripples in the supply chain. They eventually land in your pocket. In 2023, the Panama Canal Authority implemented new regulations that allowed a maximum number of 22 daily slots for transiting ships. They were anticipating increased traffic, and then El Niño hit. It caused a serious drought in Gatun Lake, a key stretch of the canal system that provides fresh water for its locks. The canal discharges enough water from the lake to fill up 76 Olympic-sized pools with each transiting vessel. Thanks to the drought, water levels dropped, meaning fewer ships were able to pass through. By February 2024, the authority was able to revise the number due to unexpected rain and raise the number to 24, but it was still less than the 36 to 38 ships that normally transit the canal daily. The impact was massive. It created a backlog of ships that grew steadily. At one point in August, there were more than 160 ships in the queue. Some dropped out, opting to add thousands of miles, millions of dollars, and transit time to their journeys. They went around the tip of South America, the Cape of Good Hope at the bottom of Africa, or the Suez Canal instead. Ship owners were bidding up to $4 million to snap up the slots that those ships had vacated, more than 20 times the normal rate. The backlog spread through the supply chain like a contagion. When ships couldn't reach their destination ports, the trucks waiting to haul their cargo sat idle. The result was drought-induced bottlenecks that stranded enough cargo to fill a line of semi-trucks stretching from New York to London. The economic damage caused went far beyond Panama. The disruptions lasted for months. In South America, the Amazon River and tributaries like the Rio Negro hit record lows. Communities were isolated, local economies were crippled. In October 2024, 8 months after El Niño subsided, the Rio Negro plummeted to a depth of 41.5 feet. It was the shallowest depth recorded since measurements began in 1902. The low waters stranded cargo boats and river ferries, cutting off hundreds of thousands of people in Brazil, Peru, and Colombia. Again, that was a strong El Niño. This next one is even stronger. If one El Niño can shut down the world's most vital canal and largest river, what happens during a super El Niño? Chapter 3. The Energy Trap. We already got a preview in 23 and 24, and nowhere was it more devastating than in Zambia. This landlocked nation is reliant on hydroelectricity for 85% of its power. Much of that comes from the Kariba Dam. The Kariba North facility is the centerpiece of Zambia's hydroelectric network, responsible for about a third of total power output. Or at least it was. The same El Niño-inspired drought that hit Panama struck Kariba. By September 2024, Kariba North's output had sunk by 90%. The lake's live storage, the water used for power generation, had fallen to just 3.6 feet, one of the lowest levels in history. Zambia's other hydroelectric plants were in a similar state. The knee-high water levels quickly brought the country, well, to its knees. Zambia's national electricity demand averages around 2,400 megawatts. By September, its supply had fallen to 900 megawatts, a roughly 60% reduction. To stabilize its collapsing grid, the country's power utility, ZESCO, was forced to implement rolling blackouts known as load shedding. As the crisis deepened, the blackouts were extended. At its peak, the entire nation was plunged into darkness for up to 21 hours a day. Zambians had already become used to 4 to 8 hours of load shedding before the 21-hour cuts started in September 2024. 8 months later, they were still facing 17-hour power cuts daily. Today, the country is still plagued by variable load shedding because the energy deficit hasn't been resolved. The consequences of the last El Niño on the economy have been severe: reduced industrial output, lost business hours, and slower economic activity. But the loss of power generation has also had another potentially more disastrous long-term effect: disrupting the transition to cleaner, greener energy sources. Like most countries, Zambia has been moving to diversify its energy with the introduction of cleaner technologies. The country had signed a string of deals for solar plants. These include a $2 billion deal with the UAE's state-owned company Masdar and a power purchase agreement with the Canadian firm SkyPower Global. They hope to supply enough solar energy to power 4 million households. Now Zambia has resorted to a desperate attempt to keep the lights on. They are turning to coal. In June 2026, the country's state investment arm ZCCM Investments Holdings announced a partnership with the Chinese-owned Wonderful Group Services Limited. The goal is to develop a major coal-fired thermal power project expected to generate up to 600 megawatts of electricity. The government doesn't have a choice. It needs to keep the mines operating, factories running, and households connected while renewable alternatives continue to develop. It says that coal offers something that solar and hydro can't. It generates electricity around the clock, regardless of rainfall, cloud cover, or seasonal weather conditions. But it's also accelerating a global climate disaster. Short-term survival is being traded for long-term catastrophe. In a cruel twist, the transition to green energy is being sabotaged by the very climate change it's meant to fight, and the damage doesn't stop at power shortages. Chapter 4. The Rice Wars. The lack of water isn't just turning off the lights, it's emptying global food reserves, raising the prospects of widespread famine, and surging prices for scarce staple foods, like rice. In the past decade or so, India has become the world's largest rice exporter, accounting for 40% of global rice exports in 2022 and 23. Any disruption to Indian exports reverberates dramatically around the world. And that's exactly what happened during the 23-24 El Niño. Across Asia, rice is the foundation of people's diets. It provides between 40 to 67% of total calories consumed. Countries from Bangladesh to Nepal depend heavily on imports from India. That's why panic spread in July 2023 when India suddenly banned non-basmati rice exports with immediate effect. More than 40 countries rely on India for over half of their rice imports, and the ban affected roughly 25% of India's total rice exports. It caused instant panic. The ban lasted for around 14 months, with the Indian government lifting it in September 2024. During this time, India's total rice exports fell by 34% compared to the previous year. Non-basmati white rice exports plummeted by 88%. It was the caloric equivalent of removing every grain of rice from the shelves of every Walmart in the US. The effect? Massive rice prices around the world. Countries across Asia and sub-Saharan Africa rushed to find new suppliers, but Thailand, Vietnam, and the other major exporters were being hit by El Niño too. By February 2024, the price of benchmark Thai rice had surged 22%, reaching levels not seen in 15 years. The shock didn't stop there. Rice prices spiked across Asia and Africa, hitting countries like Nepal, the Philippines, and Senegal particularly hard. The disruptions undoubtedly increased food insecurity and poverty in some of the places that could least afford it. Welfare losses in sub-Saharan Africa alone are estimated at around $353 million as a direct consequence of the ban. Since the ban has been lifted, India and other nations have increased supply. It's contributed to a significant drop in prices back to more normal levels, until the next Super El Niño hits. If domestic supplies are threatened, India has proven that it is prepared to pull the plug on exports to stabilize the domestic market. And it's not just rice. All water-intensive crops like sugar, palm oil, and cotton are at risk. Few things disrupt societies faster than basic food becoming scarce and unaffordable, especially in developing countries. Rising migration, geopolitical instability, conflict, and higher grocery bills could become more common. The $12 chocolate bar, water shortages, and rice crises aren't isolated disasters. They are linked by a massive atmospheric system, and that system is breaking down. Chapter 5: The Invisible Engine. When it comes to El Niño, most of the focus has been on the way the phenomenon causes higher sea surface temperatures in the tropical Pacific Ocean. This in turn leads to disrupted rainfall, droughts, flooding, and a myriad of other climatic ills. These problems are all too real, but higher temperatures aren't the most dangerous effects. El Niño is breaking the global rain machine, and the consequences could be unimaginable. The east-west atmospheric circulation above the Pacific Ocean is known as the Walker Circulation, and these wind patterns determine how global trade flows. They also play an oversized role in shaping the global climate. Air rises in the tropical western Pacific and travels eastward high in the atmosphere. The air then sinks back down to the surface over the eastern Pacific Ocean, where the surface winds blow it back toward the west. It's not always constant. Sometimes it's weaker, sometimes it's stronger. During an El Niño event, the Walker circulation weakens, reducing easterly winds across the tropical Pacific. That shift disrupts global weather patterns, and the western Pacific, including Indonesia and Australia, becomes hotter and drier, often leading to drought. At the same time, the eastern Pacific sees the opposite: heavier rainfall and flooding in places like Peru and Ecuador. The result is extreme imbalance. Some regions get far too much rain, others far too little, and the consequences spread through crop production, disaster risk, and economic instability worldwide. And your grocery bill. During the 23-24 El Niño, peak sea surface temperatures reached around 29 to 30 degrees Celsius, the fifth highest on record, but this time the Walker circulation didn't weaken as much as expected. The effect of warmer Pacific waters was partially offset by unprecedented heat in the tropical Indian and Atlantic Oceans. That extra warmth triggered atmospheric changes that strengthened the trade winds and reinforced the Walker circulation, counteracting the Pacific's influence. As a result, the average rainfall anomalies in the tropical Pacific were much lower than expected, but it would be a mistake to think we escaped lightly. We didn't. Because the effect of this broken rain engine doesn't stay in the tropics, it actively hunts down the rest of the globe via the jet stream warp. Tropical rainfall is the heating source that drives global atmospheric waves. Because the effect on the Walker circulation was weak in 23 and 24, the event failed to trigger strong extratropical teleconnections. Teleconnections are recurring, large-scale patterns of atmospheric pressure and circulation that join climate anomalies across thousands of miles. They act as a kind of a bridge, allowing weather changes in one region to influence weather in another. Teleconnections can last weeks to months and often return in cycles. That's what makes them so important for seasonal forecasting. By monitoring source regions, meteorologists can predict weather in far-off response regions months in advance. That makes it a powerful tool for preparing for droughts, floods, and extreme heat. It also helps to keep prices down. The 2023-24 weak teleconnections had three major and entirely unexpected consequences. First, meteorologists were expecting a weaker Walker circulation to deliver a much-needed wet winter to the southern tier of the United States and California. The region had been grappling with a severe drought, but it never really materialized, and the drought went on. Second, if there's a silver lining to El Niño, it's that it tends to put a damper on hurricane activity. The high vertical wind shear typically tears hurricanes apart. However, because the atmospheric circulation response was weak, this shear didn't materialize over the Caribbean and the Atlantic as expected. As a result, the 2023 hurricane season became the fourth most active on record. And third, seasonal forecasts became unreliable. The normal links between Pacific sea surface temperatures and global climate patterns broke down. So even when El Niño acts differently than expected, its impact is still severe. And that's because the effects aren't just limited to the tropics and coastal regions. Chapter 6. The Jet Stream Warp. The planet is one big, deeply connected weather system, and the effects of El Niño touch every corner in one way or another. In the US, it turns weather patterns upside down due to El Niño's impact on a critical planetary weather system, Rossby waves. Also known as planetary waves, they're a type of inertial wave that occurs naturally in rotating fluids. They're found in the atmospheres and oceans of the Earth and other planets due to the rotation of the planet. Rossby waves are giant atmospheric and oceanic patterns that help shape global weather. In the atmosphere, they steer pressure systems and the jet stream. In the ocean, they travel along the boundaries between warm surface water and cooler, deep layers. El Niño disrupts this entire system. It shifts the main source of atmospheric energy, the Rossby wave source, from the western Pacific to the central or eastern Pacific. During El Niño, warm sea surface temperatures in the central and eastern Pacific trigger intense upward motion in the atmosphere and heavy rainfall. This forces the air to spread out high in the atmosphere, creating a region of what meteorologists call upper tropospheric divergence. As this airflow interacts with the Earth's rotation and background wind patterns, it generates a strong Rossby wave source. That source acts like a starting gun, launching a stationary Rossby wave train that travels northeast along the jet stream into the middle latitudes. In the United States, this often sets up a persistent low-pressure system over the Gulf of Alaska, a defining feature of El Niño winters. The result is dry conditions that often develop over western Canada and in the northern U.S., while storms and cooler air are directed into the southern U.S. No snow in the Midwest? Nasty unseasonal storms in California? Now you know why. But this doesn't just affect the US. Thanks to teleconnections, the effects are felt around the world. These strong wave trains can propagate upward into the stratosphere, where they weaken the polar vortex. That disruption can later descend, triggering sudden atmospheric warmings and often cooler winters in Europe. At that same time, the same system can drive extreme heat in regions like the Sahel in Africa. In other words, nowhere is spared. And because Rossby waves can become stationary, they can lock weather systems in place. That leads to prolonged extremes, standard droughts under persistent high pressure, or flooding rains under stationary low pressure systems. And persistent unnatural weather conditions only lead to one thing: higher prices at checkout. Now you might be thinking, well, at least El Niño only comes around every couple of years, so the effects are temporary. Unfortunately, that is the best case scenario. The scariest part about all this is that we are entering a permanent El Niño state, where the Pacific's cold water upwelling is structurally weakening. The cooler years today are now warmer than the hot years of the 1980s, and that trend is clearly escalating fast. Chapter 7. The Death of the Cycle. For all of the havoc it caused and is still causing, the 23-24 El Niño was milder than predicted. Even so, global sea surface temperatures in 2023 and 2024 exceeded those of the 1997-1998 Super El Niño by 0.2 to 0.3 degrees Celsius on average across the entire ocean surface. To put global ocean warming in perspective, the oceans are absorbing energy equivalent to 5 Hiroshima nuclear bombs every second. The world is still reeling from the effects of the last El Niño. The hangover effect of residual heat has been even more devastating than the El Niño disruptions themselves. Now the current one is upon us, and it's anticipated to be the strongest one since the 1870s. But before we've even had a chance to recuperate from that one or its after effects, the next El Niño will arrive, and then the next. So the forecast for relief on your grocery and utility bills is increasingly grim. Food shortages and supply shocks are highly likely to diversify and worsen. So is political instability and conflict. But there is another El Niño-induced factor that's also contributing significantly to inflationary price pressure on all goods and services. The modern world is becoming uninsurable. Chapter 8: The Insurance Cliff. El Niño's impacts on teleconnections are driving up global insurance premiums by creating unpredictable, simultaneous, and widespread weather extremes that overwhelm traditional risk models and deplete reinsurance capital. A super El Niño is an event capable of impacting risks across geographies, perils, and lines of business. The potential impacts are difficult, if not impossible, to predict. For insurers, this is the ultimate nightmare. El Niño patterns can simultaneously trigger flood losses in one region, drought-driven claims in another, and wildfire exposure elsewhere. That means more claims and higher reinsurance costs. It is of particular concern in the U.S., where many in the flood zones remain structurally underinsured because standard homeowners policies exclude it. You've probably already guessed where this leads: higher premiums across the board. And on top of all the other inflationary pressures, those higher premiums will be passed on to consumers, causing prices to rise even more. The old normal is gone. El Niño has deleted it. This is the new normal, and the best approach to it all is to just get used to it. Somehow, no matter what happens in the world, we always end up paying more, and understanding why is where things get complicated. The United States wakes up with millions of people getting ready to play a role in the economy. From the workers keeping the retail sector running to the stockbrokers handling huge amounts of money, everyone plays their part. But today is no ordinary day, because today is the day the U.S. economy begins to collapse, and it'll happen sooner than anyone knows. That's not to say an economic collapse happened out of nowhere. There are warning signs all around, and many economists have been trying to tell people for a long time. Inflation has likely been high for a long time, bordering on hyperinflation. When money has less value, the price of goods and services goes up too. And as salaries rarely rise with them, it becomes harder and harder to afford even basic goods. The economy might have been slowing down in growth as well, with many people on unemployment. The combination of these two factors leads to a condition called stagflation. This puts the government in an unfortunate bind, as the methods needed to lower inflation might lead to higher unemployment. It's a bad state of affairs, but the dam is about to burst. The stock market is the method most people use to gauge the health of the economy. If it's doing well, people are likely to keep investing, but when there's a sudden lack of investor confidence in the market, it can go downhill in a hurry. And it doesn't take much. If a major player suddenly goes bankrupt or a bad economic or global news drops, people start selling their stocks. Tension over current political affairs, like the pending vote to raise the U.S. debt ceiling, only makes things worse. When some people start selling, others follow suit, and the snowball effect starts. Easy to get started, hard to stop. And that's where the panic starts. In a matter of hours, billions of dollars are lost in the U.S. economy. Major companies see their stock value drop precipitously, some losing much of their net worth. And let's not forget about the billionaires. Many of them, like Jeff Bezos and Elon Musk, have their net worth heavily tied up in stock holdings. That means they lose and gain billions of dollars while sleeping, and today they might just see half their net worth disappear into thin air. It's a disaster for everyone from the billionaires to the small investors who see their retirement savings go up in smoke. Many companies see their entire net worth disappear, and by the close of the trading day, countless people are out of work and facing an uncertain future. But it's only going to get worse from here. Day 2. The U.S. government is in a panic. This is the worst day for stocks since 1929, even eclipsing the chaos caused by the Great Recession of 2008. They know something needs to be done, providing aid to keep the economic collapse from getting worse. That's what happened in both 2008 and 2020. After the stock market collapse in 2008, a costly bailout bill was proposed, giving many of the businesses who were about to fold an infusion of cash. And in 2020, as the stock market collapsed due to the coronavirus pandemic, the government provided both aid to businesses who were shut down and direct payments to Americans who were out of work. That should work again, assuming the Republicans and Democrats can work together. No big deal, right? Not this time. A hurried bailout bill designed to stop the stock market collapse is voted down by a narrow margin, with some on the far right not wanting to spend taxpayer dollars and some on the far left wanting a more robust bill. The result is a further loss of confidence in the U.S. economy, complete with a stock market slide to match. It's starting to look much less like a recession and more like depression, and people around the world are paying attention. The stock market has lost more than 10% of its value in only 2 days, and everyone who relies on the U.S. government for money is starting to get worried. That includes Americans and those abroad. The U.S. government runs a deficit, a massive one, and many of those dollars are owed abroad. The U.S. national debt right now is a whopping $30 trillion, and as the U.S. economy continues its free fall, that'll have a global fallout. The U.S. dollar declines in value quickly, and many of the creditors are worried they'll never get their money back. So some might decide to call in their debts while they can, to which the U.S. might start by saying, "I'm good for it, man, I'll pay you next week." But it's not just the big economic players who feel the damage created by the collapse. As businesses shut down due to the stock crash and resulting bankruptcies, more people start to find themselves out of work. They worry where their next meal will be coming from, and what would happen if society breaks down as a whole. As night falls on the United States for the second time in the midst of a massive economic collapse, many people look at the news and say, "We better get out there tomorrow and pick up some supplies, just in case." And that might just make things worse. Day 3. The start of the trading day is 9:30 a.m. and most people heading to the stock market floor look like they're heading to an execution. No surprise, things look grim from the moment the trading starts, but elsewhere there's already chaos. Grocery stores around the country are seeing a surge in buyers, emptying shelves similar to the way they did in the early days of the pandemic. The sense of uncertainty has driven people to worry about shortages, and that means they're going to create those shortages themselves by stripping the shelves. Soon news footage starts coming out and it's not good, because when people are in a panic, they act out. The first footage shows 2 old women brawling over the last pack of eggs. Next, a video comes out of a man punching out a supermarket manager because she tells him they've run out of meat. Shots of people looting and running out without paying are common, and robberies in the parking lot start cropping up as well. By the time evening falls on the US, several major supermarkets and big box stores have been looted, which means they aren't going to be open tomorrow. But hey, at least they're not on Wall Street. The overall losses have fallen to around 20% of the overall stock market in only 3 days. The panic has grown to an apocalyptic level, and people are starting to ask, should the stock market open tomorrow? Historically, major events have led to temporary halts in trading. Assassinations of presidents, outbreaks of major wars, collapses of major businesses have led to shutdowns, and the 9/11 terror attacks led to a 6-day halt. Temporary halts prevented massive sell-offs during the coronavirus shutdown, but it couldn't stop the damage. Stock market halts can also be triggered at 3 thresholds: -7%, 13%, and 20%. And as the market crosses the 3rd threshold, powers that be say shut it down. So the stock market won't lose any more dollars tomorrow. But will that solve the problem? Day 4. People have started realizing this is bad, and it's not going to get better anytime soon. Much like the last morning's panicked grocery shopping, people are worried about another shortage today: money. Most people don't keep much cash on hand, instead keeping all their money in the banks and relying on credit cards to do much of their shopping. But the fear makes people seek out something a little more reliable, so they head to the bank and do some larger than usual withdrawals. And once again, they're far from the only ones. Footage comes out of lines snaking in and out of bank drive-thrus, clogging traffic. Many people are withdrawing their entire life savings, and banks are running out of cash on hand, forcing them to turn people away. As it becomes clear that this panic isn't abating, many banks start to put withdrawal limits to avoid having to close down and to make sure everyone maintains some access to their account. It could be worse. During the Great Depression, many banks went under entirely, and many people lost their life savings as a result. Since then, banks have been insured by the government to prevent that from happening again, as long as the US government is in semi-functioning order. And that's not something we should ever question, or is it? With the government failing to pass a relief bill, the president has been reduced to passing executive orders. He's tried to unlock some emergency funding, but his powers are limited and the bleeding doesn't seem to be stopping. He's ordered the leaders of both parties back to the negotiating table to hash out a bipartisan bill, but both have come to the table with their own demands and aren't in a compromising mood. Making things worse, he spends most of the day fielding angry calls from other world leaders. They've been watching the news and they're concerned about what they're seeing. Is the US economy on the verge of collapse? Right now, everything's in a holding pattern, but it's about to get worse. Day 5. The scariest thing about day 5 of the American economic collapse isn't what's happening, it's what isn't happening. The stock market is staying shut, and no one seems in a hurry to open it again. Many of the banks that dealt with the cash rush yesterday are staying closed too, with some making people arrange meetings to do withdrawals in person or putting strict limits on the amount that can be taken out. Many smaller banks are just keeping their doors closed and not allowing anyone to withdraw money. Grocery stores are reinstating pandemic-era policies, only letting a small number of people in at a time, and by the time people do get in, most of the shelves are empty. But they say there's no scarier words than, "I'm the government and I'm here to help." Congress wasn't able to pass a relief bill yet, but they're still negotiating. Debts are coming due, and countries outside the US are starting to wonder if the US has a handle on things. They don't, but the president doesn't want everyone else to know that. The first priority is an infusion of cash to start paying off bills, and the best way to do that is by printing a lot of money. An executive order has the Federal Reserve putting cash on the printer, and the US is able to take care of some pressing issues. But that has a nasty side effect, diluting the US dollar and contributing to an already brutal inflation number. We're not quite at Zimbabwe level yet, where they printed billion-dollar bills and people needed to show up to stores with wheelbarrows of cash, but economists are getting nervous. And a far bigger crisis might be just around the corner. The United States debt ceiling is the key to keeping the machine running, and the US usually runs a heavy debt. And when they don't have the money on hand to pay for something, they just borrow more. The government sets a limit on the amount of debt the country can carry, and periodically they have to vote to raise it. That deadline is sneaking up fast, and while the congressmen are debating on what a relief bill should look like, this might be an even more pressing concern. Because if the debt ceiling doesn't get raised, the US defaults on its debt, and that's when things get really bad. Day 6. Congress has been called back to vote on raising the debt ceiling, and the whole country and the world is watching with bated breath. If they pass the bill, the US will be able to find some creditors to tide them over until the economic crisis passes. If it fails, default will come almost immediately on a segment of non-bond US debt, further undermining confidence in the economy and sending not just the US markets, but the world markets into a panic as the world's largest economy continues to convulse. With the stakes high, surely a clean bill can be passed to give the debt ceiling a temporary boost, or at least pass a temporary dispensation, right? Nothing's ever so easy in Congress. It's clear the tensions from the relief bill are spilling over from the minute the debate begins, with multiple congressmen stepping up to raise objections to the bill or offer amendments that are only loosely related to the matter at hand. Arguments fill the halls of the House of Representatives, and making things worse, the controlling party only has a 5-seat margin, with around 10 hardline members who often disagree with leadership. They need 218 votes to pass raising the debt limit, but the final bill has multiple poison pill amendments that have angered both the base and radicals. And when the vote roll is called, it falls short with only 210 votes. And the entire world watches, as the United States is about to default on a portion of its debt as of midnight. Around the world, in stock markets that are still operating, people start selling off their shares of American companies. The American dollar continues to decline rapidly, and the exchange rate becomes brutal for Americans looking to spend money outside of the country. And around the world, various powers start to sharpen their knives as the US looks weaker than it's been in over 100 years. Could this be the end of the United States as a great power, or will it be another economic bump in the road? A whole lot of people are waiting to find out. Day 7. As the economic crisis enters its first full week, the president is not happy. He's already called up the leaders of both parties, reading them the Riot Act, and then watched with dismay as the clock rolled over and America officially was unable to pay its debts. He spent the rest of the early morning on the phone with allies, assuring them this was only a temporary problem and they'd get their money in short order. Some, like most of Europe, were understanding, although rumblings in the streets of Europe was that doing business with America was not a good proposition right now. But other countries were less understanding. China, the single biggest US creditor, wasted no time, and reports started circling the globe of outposts of US companies being placed under Chinese control and US ships being detained at Chinese ports. The president had several tense phone calls with Chinese leadership, but the Chinese were cagey and wouldn't admit that there was an official policy of seizing US assets, although they wouldn't deny it either. And in the throes of a massive economic crisis at home, the US wasn't looking to add an international crisis to that. So the president had little choice but trust China's word and slink away quietly. Back on the home front, things were about to go from bad to worse. A week into the crisis, many companies were struggling with a massive cash flow problem. Many owners had seen their company's value drop like a rock, or had problems getting the cash they needed to grow their business. Expansion plans were put on hold, planned loans were canceled by timid lenders, and thousands of small and mid-sized businesses had seen their narrow profit margin disappear and were forced to close up shop when it was clear they would not be able to make this month's rent. And that put tens of thousands of new people out of work and on the unemployment rolls. causing massive backlogs in the systems. Tensions are rising and people don't know where their next paycheck will come from. That's a recipe for a tinderbox about to explode. Day 8. One area hasn't suffered much in the economic disaster: social media. As the pandemic grows, everyone with access to the internet is using social media to vent and make their own suggestions for what to do, and everyone seems to hate every other idea. Political tensions are higher than ever, and everyone seems to agree on one thing: it's the government's fault. All it takes is one spark to make things boil over, and this comes when a video goes viral of an interaction at a supermarket. An old woman with a basket of groceries finds that her credit card has been declined and is roughly handled by security when she begs them to let her take the food anyway. That sparks a brawl in the store, with customers brawling with security and later police. The footage spreads around the world in a matter of hours, and the public is not happy. It starts as localized riots around the scene of the initial fighting, but soon people in cities and suburbs around the country are taking to the streets. Some are ransacking supermarkets in a stepped-up version of the initial food wars. Others are taking their frustrations out on government buildings, looting stores, or brawling with the authorities in the streets. The police are out in force, trying to maintain order, but some find themselves outnumbered, and others aren't interested in fighting with ordinary Americans in a panic over the economy. The public feels like the government isn't doing anything, and that's something that cuts across all political lines. And one figure is taking more of the heat than anyone else. When a mob of protesters starts gathering at the White House, the Secret Service keeps an eye on it nervously. After all, protesting is legal. But when they start approaching the fence and tossing things over it, they spring into action. The Secret Service quickly tries to disperse the crowd, but several agents are injured by tossed bottles. They fight back, arresting some protesters and injuring others, and the president is quickly ushered down to the White House bunker. The crowd is eventually dispersed, but it's clear something has unleashed, and it's not going away anytime soon. And the rest of the world has noticed too. Day 9. The footage of American cities and suburbs in flames has gone viral around the world, and the president has given a shaky speech from the bunker calling for peace. To put it lightly, it didn't raise anyone's confidence about the state of things. States have begun calling up the National Guard to restore order, but reports are coming in of guardsmen refusing their orders. After all, they might be facing off against their own loved ones, and many of them are also looking at their bank accounts, terrified of what's happening. Even more businesses choose to close down after last night, some suffering serious damage in the unrest, and others not wanting to expose themselves to the riots if they kick off again. And some radical solutions are being proposed. So what's more important, the United States' economic health or the country staying a democracy? Powerful members of both parties have called for the president to declare a state of emergency and take extreme measures, including seizing the assets of some of the country's most powerful billionaires. After all, those several $100 billion might come in handy. Of course, they probably can't agree on which billionaire should be first in line. Probably the one they disagree with the most. But one isn't waiting to find out. Word starts getting around that Elon Musk took a private plane to Canada overnight, where he still has citizenship. And he's not the only one losing faith. Word starts spreading around the world of more and more American assets being seized by other countries. It continues in China, but other less powerful countries are joining in. Even the US's allies in the EU and the Anglosphere are sounding increasingly agitated about the situation, demanding answers from the president as the US dollar keeps inflating and the political situation gets increasingly volatile. Around the country, those well-versed in financial matters decide to get what they can while the dollar still has some value, and many try to trade their cash in for commodities with a solid value, like gold. But will gold even be worth anything in the event of a complete economic collapse? Day 10. Most people have lost faith in the United States' ability to pull itself out of this economic crisis anytime soon, and it's looking more like a full-on collapse than a recession or depression. The dollar has plunged to an all-time low around the world, thousands of businesses close by the day, and the public is in a panic. The president addresses the nation again, announcing emergency executive orders keeping the stock markets closed and instituting strict limits on cash withdrawals to prevent another bank run. However, he doesn't announce any of the far-reaching radical moves some wanted, although many say it's just a matter of time. All around the world, a massive ripple effect begins to emerge. Even the US's closest allies see a grim trend. Pending details with American companies are called off, ongoing projects are put on hold, and branches of American businesses abroad start to shut down due to the contraction of the US economy. Many online markets stop taking the dollar altogether because it's too volatile to make a reliable currency as it declines by the day. The seizure of American businesses and ships in less friendly countries continues, but the US is too preoccupied to care at the moment, and many American citizens abroad start to head home. Not that home is looking all that inviting. As the public starts to prepare itself for a prolonged economic crash and possibly a total collapse, what'll they need? The hoarding we saw in the first days wasn't exactly productive, but longtime preppers have a plan for the worst-case scenario. They're stocking up on food with a long shelf life, water filters to ensure a supply of clean water, clothing for the winter, tools including axes that will allow them to cut wood for fire and serve as a weapon in a pinch, first aid kits, battery-operated radios, and flashlights in case the power goes out. Most of these are worst-case scenario items for total societal collapse rather than an economic collapse, but who knows where we're headed. Is there a way out of an economic collapse? That heavily depends on what the government does. Some countries like Venezuela and Zimbabwe doubled down on faulty policies that led to hyperinflation and greater isolation from the world. Others like Argentina were able to rebound from defaulting on their debt by negotiating with their creditors and restructuring their debt. It was a long, hard 4-year depression, but they eventually started rebounding economically and came out of the default. They just needed to work together and establish savvy policy. Good luck with that, Congress. Want to learn more about what happens when it all goes south? Check out What Happens to a Country When It Goes Bankrupt, or watch Great Depression: What Was Life Actually Like, for a look at the last time the country hit rock bottom.